Check 1, 2.
This leader
check.
is provided to permit the projectionist to complete
1, 2, 3,
adjustment
4,
of
1, 2, 3,
focus
4.
and
Check,
sound
check.
level
Losing my voice.
before the film begins.
Starting to lose my voice here. Check 1, 2. Mic check.
This leader is provided to permit the projectionist
Check
to
1,
complete
2.
adjustment
Need
of
a new
focus
microphone.
and sound level
All right,
before
we'll
the
do that.
film
We'll go to a
begins.
new mic. Check 1, 2. Mic check. We gotta get a new mic. It's about that time. You guys can hear that? Ooh, yeah. I see some of you already in chat. Good morning out there. See what you can do with this here. Fed rate day, baby. Fed rate day. Check 1, 2, mic check. Fed rate decision day. This is where we shine, baby. It's the main attraction. Rock and roll. Here we go. Fed rate decision. What else we got going on here? Public. Good morning, everybody out there. Good morning, good morning, good morning. How's everybody doing out there right now? Can get right into it here. Hold on here. Let me do this here. Switching right over. Okay, good morning out there. How's everybody doing out there, by the way? We are doing it. Everybody's already starting to roll into the stream. Good morning. Happy Fed Day, everybody. Good to see you all. Give me one quick second. I got a few housekeeping things I got to do for the show this morning. And we're going to leave the chat on this morning for anyone to speak. Let me see. I have just a few things got to do here. So, subscribers, it's free. If you're on YouTube, you just have to click the subscribe button. It costs nothing. It's one of those days where I realize that people get excited, right? It's Fed Day, baby. And hold on there. Let me get all that going. All right. So good morning to you. Welcome back. It's Fed Day today. Let me close this here. Make sure we're all good to go right there. How's everybody doing this morning? Let me read through the comments here and read what you guys are got. Oh, let me go over to Twitch and turn on the comments for Twitch too, so that anyone can speak just today. Subscriber only chat, will turn that off. You should be able to chat freely on Twitch this morning. I don't expect too much right now, just out the gates here. Not expecting too much from the market. Normally on days like today, I'm expecting like Harlem Globetrotters pre-show. Classic trading setups, those kinds of things. I'll go through a bunch of news for you to prep you for this afternoon. So in the background, you'll just see me this morning going through some gamma stuff, going through where the levels are, the expected moves today that are priced in, and we'll talk. We'll do some talking this morning. I think we might have a few guests on, 1 or 2 or possibly 3 guests on this morning. Spoke to some people yesterday. I'm not sure on that yet, so bear with me. Let me do one more mic check here because I got some weirdness going on. That's better. Nope, that's better. I like it better like that. Okay. We are parked right now at the gamma bar at
1 minute
4650,
remaining. I'll lead with the EIA crude oil inventories.
trying to break above it to 4700. Unless we trade underneath the hourly trigger, the trend is up. Whether you know that or not, I don't know. Came up here last night and blasted. Remember this PT3 that we had here yesterday? So we did that this morning, right? Blasted up here. Got our PT2 yesterday. And then in the overnight and this morning, went up and tagged our PT3-ish, kinda, sorta. And what does that mean? All right. That means that if we can stay and get above here, we're going to start to attack some pretty big targets to the upside. And we'll take a look at those today. Like, where can some of those targets be?
10
How fast
seconds.
the market can move here, if it's up or down. Are we looking for liquidity to the upside? There's a lot of. It's kind of weird as we get closer to 4750, 480. The closer we get, what is the end result? There's no
Draw
the
of
call walls at
4.259 million, a
4700.
draw
So
of 4.259 million. That's lower than the expected draw of 1.8 million. Gasoline inventories, a build of 0.409 million, build 0.409 million, which is lower than the expected build of 1.9 million. Distillate inventories, a build of 1.494 million, 1.494 million, which is larger than the expected draw of 0.193 million. Crude Cushing inventories, a build of 1.228 million, a build of 1.228 million. Some strength in WTI crude following EIA inventories, a larger than expected storage draw.
thanks for the birthday wishes to my daughter, my oldest. It's her birthday this morning, and I'm a little sad. I'll be honest with you. I don't want to lose her, and I'm gonna lose her. And my wife and I, we spent our lives involved in our kids' lives, and that's not the case for everybody, or everybody's experience growing up. But it's kind of sad, man. I'll be honest. You know, whoever she meets in her adult life, friends and experiences and all that stuff, they're gonna have an awesome experience with her because it's been nothing but a joy from our end. Nothing but a joy with my oldest daughter. I'm telling you, it's like this is the child that is like wants to explore
Now posted
everything,
out the weekly
learn new
EIA inventories
things.
report on the feed
No
for
matter what
anyone
you're doing,
interested.
she wants to do it with you. If I said to her, let's go hike the Appalachian Trail, she'd do it. If I said to her, let's go surfing right now, she'd do it. If I said, let's go fly to Mars right now, she'd do it. She's like the coolest kid in the entire world. All right. Hold up. Let's see what we got going on here. That's all done. Gonna switch over to SPY really quick down here. Get you guys some levels. This is what we looked at yesterday on this bottom chart just below me. Talked about this yesterday, right? We're targeting this area here, and we've already tagged it, and then we're looking above it to the next level. So I can put this on a 15-minute chart here. And if we can grind above, let me see if I can switch over here. It's a 15-minute chart that I showed you yesterday for some expectations, and look what we did. Come up here, yay, slammed up here. Coming back up to this previous pivot in pre-market, looking for that 465.75. If we can park it above here, we can possibly open the door into Friday to 470. So we'll look for that as well. As long as we're above, we know that unless we break below the hourly trigger, which is right down at 463.34, that the trend is up. So as long as we keep trading, as long as price action keeps doing this, we'll trade it all the way up into whatever those highs are. So I got to put some levels in for you this morning. Make sure that you guys got your targets to the upside for the day. Give me just one quick second here. Here's our one.
So in a CNBC interview, US Treasury Secretary Yellen says turbulence in the job market has really settled down. No significant uptick in layoffs.
Hang tight, guys. I'll put something on for you.
And US Treasury
Protect your trades from macro headline risk with Financial
It's
Juice Pro.
stopped going
Now
up.
only $90
So here's
a year.
Yellen speaking right now.
Real-time
Very
service.
big changes in the way people live and work during the pandemic, and I think it gave rise to pressures on real estate prices. Both rentals and house prices went up. So, young people who are have aspired to own a home, who are renting, they're seeing their monthly rent go up, although new rental prices have stabilized. If you're in the middle of a rental contract and it
Big boy up
renews,
here.
you're likely to see the rent adjust up to current market levels. And that's a big expense, and people feel
Yeah.
that.
Young
But,
people are affording
I
5K a
think we're
month.
in a path, and some important prices, well, gas prices are now way down. Number of states where it's a gallon is running at under $3 a gallon, which is great news for consumers. We saw egg prices utterly skyrocket, mainly because of the avian flu. They've come down back toward pre-pandemic levels, but still.
But elevated.
Yes.
So when do you think the Fed will achieve its 2% inflation target? When does that happen?
Well, my expectation is that inflation will continue to come down, and I would frankly expect, I don't want to do a precise forecast here for you, but I think when we come to the end of 2024, 2 is certainly, likely to be the first numeral, and I think we're getting a lot closer.
How likely is it that the soft landing continues into 2024? Because we got it in 2023, but there are risks on the horizon.
So I think there's a reasonable chance we get it. I think that we're on that path. My baseline is that we'll achieve a soft landing. Are there risks? Of course there are risks.
Pretty dovish of her.
We could experience another global shock that could be unsettling to that path, that could jolt inflation upwards or have adverse effects on the economy. Monetary policy is an art and not exactly a science
An
yet,
art.
and it requires skill and a good dose of luck to get that exactly right.
It's an art,
But
baby.
I think as a baseline, with solid probability, we're in the path for a soft landing.
So no
And I
recession.
think that's good.
What's the recession risk at this point?
Well, I believe in any year, even if you knew nothing about the economy, there's a recession risk that's over 10%. So there is always some recession risk. I don't think it's particularly high. Consumer spending, we have seen, remains solid. Consumers built up a buffer stock of saving and wealth during the pandemic. They've been spending that down gradually. That stock is eroding, but as long as it's coming back to more normal levels, and as that happens, I expect to see the pace of consumer spending slow somewhat, but probably to a more normal level that's consistent with trend-like growth, which is what I expect. I mean, another quarter like the third quarter, I don't expect growth at that pace, but look, we got more people coming into the labor force. Adult labor force participation is at the highest level in several decades. The economy can handle that. It keeps growth solid, incomes moving up that support consumer spending. I think the baseline here is very good. And of course, there are always risks, but they're not outsized to my way of thinking.
Would the Fed cutting interest rates help preserve that soft landing next year?
I'm not going to give the Fed advice on what they need to do. You know, I'm very happy with the outcomes we've seen in the economy over the last year or so, and I'm going to trust them to make good calls.
Okay, I'll ask it another way. The market is expecting a number of Fed cuts next year and has been very excited about that. It has loosened financial conditions quite a bit. Does that improve the outlook, and does it risk inflation flaring back up?
Well, both things are possible, and I think the Fed has to think about what path of financial conditions they regard as consistent with keeping the economy on a soft landing path.
Right here, boys and girls.
Want to see inflation continue to move down.
That's the one right
Inflation
there.
moves down, it's in a way natural that interest rates should come down somewhat.
467.13.
Real interest
That is the
rates would
high
otherwise
from
increase,
SPY.
which can tend to tighten financial conditions.
January of 2022.
But, you know, they
pretty
have two
close,
risks to
okay?
manage. One that is
Pretty close.
that inflation doesn't come down.
The
back
line
toward
is
their
the target right
as
here.
they
Just a
envision.
heads up.
And the other is that the economy becomes too weak. And I'm going to leave that call to them.
On a Fed day, no less. The other
Hold on a second.
thing that the market's been paying a lot of attention to lately in your wheelhouse is Treasury auctions, which is something we haven't been paying as much attention to in recent years, but now are watching because we've had some wobbly ones. Have you been focused on this?
Well, I work regularly with our team that manages Treasury debt and Treasury auctions. I meet regularly with the Treasury Borrowing Advisory Committee, which is a group of mainly private sector advisors who help us understand what's happening in the Treasury market. We always seek their advice. You know, the cornerstone of Treasury policy when it comes to debt is regular and predictable issuance. We issue across the curve. We give forward guidance in order not to surprise markets. The objective is, over time, to achieve the lowest borrowing
Hold on one
costs
second
we
here. Play out
can,
with me. Hold on.
for the federal government, and that also involves keeping Treasury markets liquid and well-functioning. And the adjustment, we did make an adjustment to, we've had to step up issuance to finance ongoing deficits and to refinance maturing securities. And in view of some stresses we had seen in the long end of the curve, we
He's
made
a
very
mean
modest
one,
adjustment.
Mr.
We're
Wrench.
stepping up issuance. We're stepping it up at essentially all maturity levels, but we chose to do a little bit less at the long end, given our understanding of the demand in markets and pressures that exist.
Are investors right to be nervous about demand with all of this issuance set for next year?
You know, I think that it's our job to keep fiscal policy on a sustainable path. And as long as we do that, I don't think there's any reason for investors to feel nervous about issuance. And I think—
Are we doing that? Are we on a sustainable path here with 6% deficits during a high growth and full employment kind of picture?
Well, the president has signed legislation that brings deficits over 10 years down by $1 trillion. We have a huge tax gap. That means taxes that are owed that we're not collecting owing to shortfalls of personnel at the Internal Revenue Service. We've achieved funding to boost that. We see greater tax revenues ahead, and the president has made further proposals over the next 10 years to cut $2.5 trillion over 10 years from the deficit path. So we do have a fiscal challenge. Our interest costs have not yet significantly risen. We've always expected that average interest rates, borrowing costs, would rise somewhat over time as we moved out of a period of exceptionally low rates. Now, if the interest rate environment remains very much higher than was expected, we'll have a slightly tougher job to control deficits, but the president stands ready to work with Congress to take the actions that are needed to do it. And the president's made proposals in his last budget, and we have another one that we're working on now, both to boost tax revenues back toward more normal levels. I think part of the problem with our deficits, it's not that discretionary spending is very high as a share of GDP. It's actually fallen substantially. But rather, the tax revenues after the Jobs Cuts and Tax Act of 2017 fell to very low levels, about
She's victory walking, huh? You notice that right now? She's pretty much just everything is fucking great.
Yes, there were.
Are you noticing
cuts
that right
there
now
as
or no?
well. And of course,
I'm
some
in calls
corporate
right now.
tax
I'm in,
collections as well as individual. And
So I'm hedged right
we need
now
to make
out
sure
my
we raise tax
ass.
revenue. The president has
There's nothing I
proposals
can
to
do right
that in a
now.
way that we believe
That's
promotes tax fairness.
I'm hedged out my ass.
And,
I'm loaded to the
at the
tits with a
same
hedge.
time, importantly,
So
when you
I
think
bought
about
some
beyond
calls
the
this
short
morning on the
term,
open. I've got
think about the medium-term and longer-term trajectory of the
I've got zero
economy.
dates for today,
What we need to
469
do is
Cs.
expand the productive
So I don't know what
portion
else to
of our
do here. At this
economy
point,
to focus on the
I've got
supply
both
side
sides
of
covered.
the
If we swing
economy,
high, I'll close
to
out the
boost
calls.
growth, to
I'll
boost
close out
productivity.
the upside of
the
my
president believes it's
hedge, and
important to
then
invest
if
in
we swing
America to
low,
do that.
I'll close those out.
Now,
I'm
the
basically
Republican agenda has
straddling
always
everything
been
here. Wherever we
cut
go, up or
tax
down, it
rates
doesn't really matter
and
to me at this point.
deregulate, to stimulate private
And we'll talk about that
investment.
too, some
But there are a
expectations on the
lot
day
of
where I expect
things
things
that
to
have
go.
been ignored.
Someone was asking late last
And,
night about
public infrastructure, the quality of our roads and
someone said, hey,
bridges,
are we going to
whether or not
470? And I was
people
like,
have access
yeah, if we're going to go to
the
470, I
internet
mean, we could
throughout
squeeze
the
to 470,
country,
475,
our
480 really
airports,
fast and then make an immediate
creating
reversal
good
to the
jobs
downside.
in,
So, but we
growing
have some
sectors
changes
of
this
the
morning that I
economy
want to
that are
discuss with you here in just a
critical,
moment.
to our
Some
security,
positive
energy,
changes. Matter of fact, I'll just mute her
semiconductors.
and I'll just start telling you about it right now, okay? I'm going to read you some stuff here in the background. I just want you to watch as I read to you, okay? GS on year-end liquidity. On average, over the past 9 years, U.S. composite equity volumes on December rebalances have increased by plus 69 or 0.69%. Or sorry, 69% versus full-year ADV. Closing auction volumes increase 3 times on rebalance days. In 2022, volumes the week before Christmas declined 15%, and volumes on New Year's Eve declined 28% versus 2022 averages. Among quarterly rebalances in the last 10 years, Q4 rebalances tend to be the largest of any quarter, nearly 15%. GS algos will employ a special volume profile, shifting more volume to the open and the close. Write all that stuff down, please. Another note this morning, a U.S. destroyer has shot down a Houthi drone, according to a defense official. Let me see here. Tech is up this morning. Materials were trading 0.9% lower this morning. A note on that one. On geopolitical front, the UN is demanding an immediate ceasefire in Gaza, but the vote is non-binding. Over in China, the Central Economic Work Conference did not signal large fiscal or monetary stimulus. As a matter of fact, I was awake this morning for the Asia Open. I wanted to see what was going to happen over there. Nothing happened to help us. Just recently, a U.S. official said the Houthi drone was shot down by a U.S. destroyer. Pfizer reaffirms its fiscal year 23 guidance, but issues fiscal year 24 guidance well below consensus estimates. There is a healthcare trade. It's probably in equipment, though, not in healthcare. We need to go over that again before the end of the year. We have a lot to talk about before end of year this year. And let's chat about that really quick. I might just interject something. So if you have been with me for a long period of time, you remember that in 2021, we predicted the rollover in early 2022. You'll also remember or recall in December, January of 2023, or 2022 into 2023, I did a long expose on Captain's Alpha, and we chose what sectors to long into 2023. Big long diatribe, and those sectors have all outperformed insanely. They were the best performing sectors of 2023. Mag 7, we called it in December. So this year we will do that once again. You'll get a post probably on the website, not on at Captain's Alpha. It'll try to basically basically have money with JPM. They write letters and notes every December for what to do in the following year, and then they delete it. I don't know why they delete it, but it comes out and then it disappears. And so we'll post that information for you as we head into end of quarter, what to look for to long in 2023. So look forward to that post. You'll get that. We get to do that every year, and we're going to do it again this year. Southwest Airlines expects Q4 unit revenues to improve to the better end of its previous guidance range. Tesla recalled 2 million cars autopilot issue, according to Bloomberg, is likely to lose government tax credits on some Model 3 models, according to Reuters. Gamma updates. Pay attention. The market wants to move up, and traders are rolling their calls puts higher accordingly, and yields are playing along. The main highlight today is going to be the FOMC meeting in the afternoon at 2 p.m. 4650 and 4605 are the key support levels for today. That means if we bounce down on either of those, that's a place for you to buy the dip. If we lose 4605, the gig is up basically for the bulls, okay? So if you see us down there and those levels are holding, you long. I longed it this morning, and it's doing pretty well right now, so we'll see what goes on here. The dealer imbalance is 1380. The gamma flip is 4570. The call wall is 4700. But we are rolling into higher calls and puts, or higher calls. So the idea here is that even though the wall is at 4700, it looks like we're getting some call expansion, possibly even above 4700. It's not there yet, but it is working its way there. Local support is at 4650. Zero date range 4605 to 4660. In a move dampening hopes for stronger economic measures, China's leadership declared industrial policy their top economic priority for next year. This shift away from immediate stimulus measures left investors feeling let down as concerns over slowing growth linger, according to Bloomberg. In other news, top Chinese housing official committed to preventing a wave of debt defaults by property developers. This marks one of the strongest pledges yet to stabilize the troubled sector, but its effectiveness remains to be seen. I want to, if you want to get down a rabbit hole, Drunken Miller-Heimer-Esker from last year did a huge report saying China should be fine, but that they have structural issues that will be dealt with in 2024. So you may want to hunt him down and see what his take is for 2024. As a matter of fact, that's when the markets really started moving when he said that earlier last year. According to the Financial Times, Washington expects the most intensive phase of Israel's war on Hamas in southern Gaza to be scaled back and become more targeted as soon as early January. That narrative and that those rumors have been circulating now for 2 days. See what else I got for you here. So we'll roll through some of the rest of this news this morning. And I'm just banging on the door right now, just banging on the door. Tesla rolls out software fix after regulators recall more than 2 million cars over autopilot defect. So we always know that's just garbage news, right? It's not like they're taking the cars back in or anything like that. They fix it in 5 seconds. One of the joys of the modern world. What else do I see here for news this morning? Any kind of pro stuff on CNBC? Not seeing a bunch here.
They're looking at 0.7, which, as Nick Timmeros of the Journal points out, 6-month annualized is 1.9.
Yeah.
It's not even 2.
Yeah, I don't. That's a pretty aggressive call. That's pretty dovish out there. If I see 2.4 right now, again, core PC for 2024, it's 2.6%. If we see that change to 2.4%, that's a big victory for the doves. And we can see all sorts of other things. I mean, look, they talk about inflation remains elevated in the statement. All they have to do is say
long-short
inflation
ratio
remains elevated, but is coming down
I'm
noticeably.
checking through a couple of these things
There's
here.
all sorts of signals they can put in here.
Non-dealer
The doves are
long-short
really
ratio
looking
this
for
morning.
any sign that they're going to be doing something in 2024 with expectations coming down, which sets the stage for them to be able to have lower rates.
She didn't give a lot of space there to those who were concerned that interest costs could eventually overwhelm the budget. She did say, I guess, if rates stay where they are appreciably, there could be a slightly tougher time, were her words, and obviously pointed to the lack of tax revenues as much as anything else in terms of those budget deficits.
Well, was she big on that?
Yeah.
How many times did she bring that up?
Falling to 16.5% of GDP as a result of the Trump tax cuts for corporations and the like. Bob.
Yeah,
as
it's
for
showing
the broader
that
markets
peaking
in the
out
couple
and
of
then
minutes we have
the
left on this
long-short
hour,
ratio.
Walking the street. What are your thoughts?
Showing
in
us
terms
like
of the action
grinding
so
and
far?
then
I noticed
rolling.
Apple shares having a nice bid to them this morning.
Do you remember last year, this day? This was the Fed meeting last year. It was a disaster. They raised 50 basis points, and they said, we're going to keep raising rates until we get inflation under control. And the market fell apart. It was a disaster. From this moment at 2:30, 2 o'clock a year ago, it went straight down for 3 days. We were down like 6% in the month of December. Normally, it's an up month, and ended down almost 20% for the year. Now, fast forward 1 year later. We're down 20% at the end of 2022. End of 2023, we're up 20%. I mean, this is kind of remarkable if you think about it.
21.2% on the S&P, and by the way, 39% on the NASDAQ.
Yeah, pretty remarkable when you think about it. Years when there's big down years, here's an interesting fact. Normally the market
Take a look at the gamma really
bounces
quick.
back. When you get down years of 20% or more are very, very
Woo. 222 million up here. 4,700. Do you see it up here? So this is the new gamma data from this morning. We're blasting above right now. You see SPX begin to blast above right here, and it is clear skies. So SPX trying to make a move higher to slam up here. Tag this 4,700, which is on deck. You want to snap a picture of this for yourself so that you can see it. We'll draw this one in right here. Whoop. And we're going to draw this one right here. Here, I'll mute my camera for you and my box. Hold on 1 second here. If you want to snap that for yourself at home, do a little quick little snip so you can see the gamma profile for today. We have a bunch of walls opening up to the upside here. Above, we've got 4725, 4750. We also have those hidden levels up there at 4800 on Bookmap, but just keep your eyes on this right now. So you can see it on SPX. That 4,700, man. Woo! Way, way up here. Higher than right here. So that's your target. You want to see it like this. These walls are opening to the upside. I don't know if we can get up there, but SPX is trying right now. Look at your face, said it came early. Yeah, I'm really fascinated by so I'm having some discussions with friends, not just one friend. I've got a few friends here, and there's a discussion or an argument here about is that magnet still valid at 45.15? And so we should talk about that this morning. But there's a very high. I've heard everything. I've seen very, very rare does. It's very rare that we don't come back down in magnet or vortex that target. So I'm fascinated by where we are into end of year, and if we let's say we blast up here. Let's just say fuck it. We trade 47.50 or 4,700, 4,800. Do we still get dragged back down to the hole of death into the end of year? Or does Jerome Powell do something today that sends us lower to trade that into end of year? It's on my mind. I'm not going to lie to you. It's I'm not scared of it or anything, but I know that I know that it's going to drag us. It's like a tractor beam, man. So maybe we'll talk about that at some point today as well. We'll take a look at the collar and its impact and traders trading to it and all that kind of stuff. Yeah. You're not the only one, though. You know what's funny? Trader Podcast is in stream and in the chats on Twitter. Doesn't matter. I've got people everywhere like, well, it looks like we blew by your 45.15 target. I'm like, wait a minute. I told you it doesn't matter if price is below or above. It'll magnet us regardless. And they're like, you didn't say that. I'm like, oh, man, you just read what you want to read. I'm like, that's okay. But not you, Trader Podcast, but I'm fascinated by it heading into end of year to see how close we get to it. And if we get, matter of fact, if we don't come back to it, it'd be a very rare occurrence, right? And if we don't come back to it into end of year, it'll be a very rare occurrence. It's usually really fast heading in that target. It's like we're just zipping there. And if we don't, it would be even if we don't. It's a very rare occurrence, right? It's like 1 out of, let me see here, maybe 1 out of 10 times, but probably higher. It's probably 1 out of 20-ish times that we don't actually get sucked into it. So it'll be fascinating regardless. It's probably the biggest thing of the quarter for me to see if we run into it or not. And there's a lot of people on the fence on that one this quarter. There's a lot of people on the fence saying, nah, that thing's not going to matter. So, and you're not the only one saying that either, Trader Podcast. And I get I understand the reasoning too, and the mechanical reasons why we shouldn't. I was thinking about, you know what I was thinking about after our conversation was, which one? Hold on a second. Let's take a look at which one I was thinking about. So I was looking at, let me see. I was thinking about, shoot, have I already done this? You guys already see this from me? Which one was I thinking about? This one right here. This is like the special one right here. Let me see if I can show it to you. This one right here is always the one that fascinates me. This is back from March into June of 2022, and it's like we're just raining down here. and just a full reversal, whoop, right up into end of quarter. It's like stuff like this that has me concerned. This is I believe this was the 17th. I believe the date on that was the 7th. Let's check the date on that one. This was the 17th right here. And I recall this, this was the 16th, so the 17th is when the reversal came in. 16th, 17th, reversal to the upside. So not that matters. Seasonally, we should have a Santa rally or a holiday rally, whatever you want to call it, Festivus for the rest of us. But this one right here, this bad little boy right here, it's like we're gonna crash, and 2 days later the narrative leaves and we're up here again, and it's just like we closed slightly lower than it, but you see the magnet into it still counts, right? So let's find out what date that was. So this was, I guess right here. So this was the 28th right here. You got the high bar and the low bar over here. So I'm fascinated by it. Like 29th I think it's 29th is the last day for the trading year here. That's the one that's got me going here. So, and looking at this one right here, my question is, do we get the blast up? And then right into the 29th, it's like wham, right down in here. Although J. Powell, I guess if he really got hawkish, possibly could send us down and we'll trade back up that way. But either way, I'm fascinated by it heading into the end of the year. Find out that if we do magnet back down into this 45.15. Yeah, the one good thing would be I would like the run better if we had the suppressed day, a little bit of down heading into the weekend, and then we make that run up into the collar and we trade 47.50, 48, whatever, 5,000 in January, March. I like that. I like it because I think it cools shit down a little bit. But I am fascinated. I have one experience where we were getting a rate cut and we squoze straight vertical, and it was just a liquidity grab to front run a back check on the market, and it was pretty wild. It was like straight vertical green bars. I'll try to find it today. This morning I'll try to find it for you and show. We have one previous experience of just straight vertical, and then we grabbed liquidity. And it was just sell. It was like 2 or 3 months of selling, slow selling, slow staircase down, and eventually that led to rate cuts. It was like a 2 or 3 month out. It was like a 2 to 3 month out front running of eventual rate cuts that came. Of course, it was like 3 or 4 months later we started getting cuts, and then they kept cutting and cutting and cutting. The process took about a year. You want a nice touch of the daily trigger. I can understand that too. Even saying that though, if we tag the daily trigger, you want it to still get above the hourly trigger. You want that consolidation to take place. Hourly trigger has been pretty good until it's going to fail. Let's take a look at you want to look at the 30-minute chart possibly, and just let's take a peek at SPY and find out what it's looking like on its velocity. Neutral on 15 minutes, declining on the 30, declining highs on the hourly, declining highs on the daily, kind of neutral right now to not bullish, though we can fix that. The one key point here would be when we are up here in this max bullishness on the daily, we can have sustained upside price movement. And we know for sure this morning that people are rolling puts and calls. So you got people out there rolling to higher highs and rolling out puts now to farther out dates and higher strikes. It's showing up inside of the data coming out of SPX I believe this morning. So I'm going to see if I can pull up this example in the past this morning. I'll try to work on it in the background. I'm going to show you guys. That it like, can we squeeze just absurdly and go up? It's possible. We've done it before. So I wouldn't discount it. I'll say that. I wouldn't discount it. And there is a thesis to be made for 5,000 and, believe it or not, 6,000. I don't know if that happens, but if it were to happen, man, it would be brutal. It would be fucking brutal if we went and did all that and just closed the door on 3,500. It would be insane. Let's go through the chat this morning and read what some of you guys are saying here. I haven't read any of the chat yet. I've read a little bit, but not much. Morning, Andre. Good morning, Jared. RS, good morning. Brian, how are you? Z. Joe Brown, Trappy Trades, what's going on? If you're just joining us right now, a heads up that the chats are open. If you're on YouTube, you can just click the button, subscribe. It's free, and then you have the ability to chat. If you're on Twitch, you can chat this morning as well. If you're just joining us, normally we close the chat due to Russian sex bots, and we sometimes will get hit and runs when the market's at peak exuberance or peak panic. So normally we close the chat so that we don't get overrun with counter alpha. Please be respectful in the chat all day long today, because we will mute you if you don't. Try to provide true alpha, not counter alpha. Try not to go off on any diatribes. If you're angry, that kind of stuff, you'll get muted. I don't want to mute anybody today. I want you guys to have an enjoyable day with us on the stream. We'll talk about the expected moves on the day today. Anyways, back to that chat thing. Just try to be cool today. If you're a moderator here, make sure that you're watching for us at any point being overrun by people that are in the on YouTube and Twitch that want to see they want to stop in at the very emotional moments of the day. What else we got for you today? Now we're going to review the expected moves on the day. We're going to go over what happens on Fed days. Typically, we'll not trade those expected moves, and then they'll reprice, and we'll then blast through them and miss the next one, and then reprice, and you'll get a bigger move a day or two later. The real move in the market a day or two later. Don't be signing up for any subscriptions. So the idea here is we're launching a website, I believe, on Friday. There are different tiers. So everything we've done has been free to this point, and we are going to maintain forever. As long as it lasts, as long as what we're doing lasts, there'll always be that free version. So you'll always get a live stream for free. You'll always get those daily levels that I give to you. You'll always get those for free. As a matter of fact, we're going to automate them now with charts and all that kind of stuff for free. And then the only thing that you'll be charged for is the Discord access. I believe it's 10. So if you want to chat and go to Discord, it's $10. So let's start level 0 or whatever. You're always level 0. You're always going to get access to the stream and the levels every day. The other thing you're going to get access to free-ish is the Discord. Now we have a problem with Discord because we're a financial retail community. We attract scammers, bots, you name it. We attract it in the Discord. So we have to close that Discord to that threat. Now that's $5 plus the 5 for chatting across YouTube and Twitch. So you got $0. You've got an ability to. You got $0. Then if you want, you can just pay the $5 to chat on YouTube. If you're like, I don't want to pay $5 to chat on YouTube, you can chat for free on Twitch as long as you subscribe through Amazon Prime Gaming. So it's just one more step to keep the scammers and the bots away from our chats. So you get the $5 level. At $10, you get at $10 you get access to Discord, and you get the ability to chat across both platforms. Then we have another level above that, and that's we're hoping to be. I'm like, I got my fingers crossed right now that we can launch a level where we have the tools for you on the website. That's very approachable in price, and then we've got a version of the tool that you can just carry with you if you don't want to get. If you just like, I don't want to be on the website, I want to be in the Discord, I just want the tool. You can have access to that. So we're trying to build that up for you right now and launch that stuff on Friday. We've got educational videos. I recorded multiple hours of educational videos. Binky's working on them, editing them right now, packaging them all up. Now, those will all be available to you, too. It's going to be really cool. We're doing a ton of work. I'm working on a bunch of other stuff that's not quite ready yet. Scanners and paper trading simulators and options profit calculators, gamma gex models coming out. All kinds of cool shit will be added as time progresses, as that stuff is all fully developed. So we're just trying to make the idea here. The idea here is that we've completed what we wanted to do. What we set out to do, we won, and we've got this kick-ass core group of retail traders, and now we want it to be sustainable. And to make it sustainable, it has to be and the demand for some form of data and development and all this other stuff from people that want to support the community and keep the community going for many more years to come. So I want to say thanks to all those people out there that have supported us to get us here, and I also want to specifically thank the people that want to make sure that the admins stay and the moderators stay and the teachers stay and the mentors stay, and all the people that work hard in the background, the moderators inside the streams, the people inside the Discord, the developers that work in the background for us, and all that other stuff. So it should be kind of cool to see where this goes. If it doesn't work, if it's like, there's no demand, nobody wants this, then we'll just shut it down and go back to what we were doing many years ago, where it's like, 10 or 100 of us or something like that. We'll just fuck around every day and hang out privately. So that's where we're at right now with that. Let's say do some more good mornings. Trappy Trades, good morning. Stacy F, good morning. Befrank, Nathan E, good morning. Oh, thanks, Stacy. I appreciate that. MSKD, good morning. Jen, OSU fan, baby. Bazra is in the house, baby. Sweet. I see Bazra's in here. Andrew, good morning. Thurston Howell, thank you for the well wishes to my daughter. I appreciate that, brother. It's a kick-ass morning. I can't wait. We're doing Sundays for a cake this year. So tonight we're gonna go out for a Sunday. We're going like an old school Sunday shop where they have like an actual soda fountain and all that kind of stuff. So it should be a pretty cool night. To the point. Good morning. How are you, man? Harushi, what up? Paul Chalos, Ricky T, John Haggerty in the house. Thank you, John Haggerty. Appreciate that. Jimmy Berry is in the house this morning. What up, Jimmy? Dan Brislin in the house this morning. Hey, did I miss the cues this morning, Dan Brislin? Dan, I'll get the cues out for you right now, bro. Hold on. Hang tight, brother. I got you covered. Did we miss it? Are you sure we missed that this morning? Hold on a second, brother. I will make sure those get posted right now. Hang tight 1 second. That's done for you. What's going on, Haggerty? Oh, yeah, big boy. Dan Frank, Sammy, what's going on? Abraham, Apple Boomin, Nat, what's going on? Chase, what's going on? Yeah, 469, Chase. 469, brother. That's right. Cap commodities are crashing. Only one to be right. Stock market versus commodities, baby. Morning, Chase Winter. Lord Pente, good to see you. Thurston Howell III, baby. Showing the support. Abraham, Steve, Jared, parlays for days, dude. What's going on, brother? Everybody's in here this morning. Everybody is here today. Big tomorrow, 98.55. Connor Wilson, short bus trader. Woo! Evan Harrington's in the house. Primal's back is here. Who else is here? Woo! Short bus trader kid time. Stacy. Hold on one second. Let me see who else is in the house tomorrow. We got the Twitch gang in the house. Poke the juice box. Nino, California. Limit buyer Bork McGork. What up? I got some penny puts, Bork McGork. I got some penny puts. I got 400 455 P's, but I doubt they're gonna print, bro. They're for today. They're like penny fucking puts. K to do it. K to Dewey. What's going on, brother? Subscribed. Good morning. Runs when, good morning. H-bombs in the house. Stretching walls in the house. John Klopp. Hey, thanks, John Klopp, for saying happy birthday. He subscribed again to Prime this morning. Old but Chazo's in the house. Trader Podcast in the house. RT84 is in the house. Big cute boy, what's going on? Hella hoy, what's going on? Bull for Trading's in the house. T-Rent Tents doing his thing this morning. Sign up Prime. Beartown Sheriff's in the house. Who else we got in the house this morning? Let's see who's on Twitch here. Legend X22X, what's up, brother? Tesla's fucking you sideways. We'll take a look at Tesla this morning. I think Tesla has a Legend. I'm wondering if Tesla is going to be that rotate into stock after this Fed meeting today. I'm fascinated by that trade. Casper Rope, Exis, Ganks, Willie Loman gets down. Good to see you. Ram Husk, limit buyer. Mission 777's in the house. Tanner LC9 saying, I watch your channel every day in a CZM 200. Figure you enjoy knowing a blue-collar guy watches you. Thanks for all you do. Same to you, brother. Same to you. I've been there, man. I've fucking been there, dude. Been there, brother. Been a blue-collar guy, too. Learned how to fix up houses. I didn't know what the fuck I was doing. I had to go out there and beg smarter people than me to teach me how to build houses. It was awesome, bro. Smile528, what's going on? Darth Molly is in the house. Goat Boy, oh, dude. Frotron Alpine is in the house. Jill Natolo's in the house. Bumbledine's in the house. Handsome Rob in the house. Limit Buyer, Spaceman's here. Dude, the whole gang is here this morning. Gringo Locals here. Dude, these names I'm listening off to you are like gangsters. What is going on? Casper Rope Access. Willie Loman, dude, what's going on, man? What's going on? What up, Limit Buyer? What up, Oda Nabunga? Dude, everybody's here. Right on. Good morning. Good morning. Sammy, good to see you. You guys want me to look at Apple? All right. You guys have been screaming Apple all morning. Let's do Apple. Just bloody screaming on Apple. Let's take a look. Oh, Apple. Okay, let's check out Apple. That's like 10 people asking about Apple. Seems pretty legit, right? Seems pretty legit. 1 minute trigger. We got a big old cross going on over here, right? Nice. What do we call this right here? You guys know what this is, right? 1, 2, 3, 4 trigger cluster with a back test. That's the big boy right there, right? Squeeze up. Back test is successful. Back test on the hourly is successful. You got the cross happening right up here. And what do? Just start launching, right? Just start launching. What do we do when that happens? We're always looking for successful back tests of that squeeze. We have one right here on the half-hour trigger, another deep one right here on the half-hour trigger. So we're going to look for that right now, right? We've got this half-hour trigger. There's your springboard. So as long as we back test 194.97, 194.51, we should continue to head higher. Let's look on the 30-minute chart and see where we are here. We've got another pump going on in the daily. We've got a little long in the tooth on the hourly and the 30-minute chart. So expecting a little bit more pullback here. Though I will say if price is above, let's go back to this 1 minute chart really quick. Give you some little places of interest here. If you're looking to buy a dip down here, it's right here. You got one right there, and you got another one right down here. Whoop. So you can start building a long position, right? If we come back down, right, start building a long position, comes down on you. Second one, here's your stops. Remember, if we go through your stops, there's usually a capitulation trade. That's where your stops actually are, is above. You know about that. What else do we have here? I think that's it. Where's the target? We know where the target is, right? It's 200. We know that target is 200, way up here. Right up there is the target. Let's just keep on plugging away. If you do see a break at any point, if we have a pullback down here and you see a failure of that hourly trigger, that's fine, but you're then looking for any kind of rejection. If that begins to happen with the hourly trigger, you're going to get quite bearish on this. Your downside target, if we do break trend on Apple, is quite low. It's 188.63 down here, okay? 188.63. So just be careful, because if they ever bloodbath this down, get underneath, we will likely trade that. We'll have some tags down here, some previous lows and stuff, but that would be the target to the downside on Apple. So right now, just looking for a pullback to buy a dip. Anyone that bought this dip back down here, congratulations. You're just parked and waiting. There's a bear cross happening right now. You guys know what a bear plane is. So we get this. If we get this little cross right down here, whoop, see that nice little cross taking place right here. Whoop. You know, you're looking for that blood, pull up, and then just straight down into that half hour and hourly trigger. That's Apple for you this morning. Come back over to SPY. Just knocking on the roof of 465. There's R2. So bring that over there for you. Is David AMS this? Is he sleeping this morning? I should call David and see if he's here this morning. I looked at Apple for you, Sammy. That was done. What else? Oh, right on, right on. Tom, I said hello too, Short Bus Trader. What's going on, John? How are you? Tim, good morning. Shum Daddy, what's going on? Wolf, what up? John Haggerty saying hello as well. Back to Short Bus Trader. Shaq Baker. Apple's bullish to me, LOL. Diamond is watching DJ. Show Tesla. What's going on? Okay, what else we got going on here? More. Hey, Anthco Zero, what's going on, brother? Dave G is front row Alpine for Fish, brother. Dude, so Fish is playing in Vegas, right? Is that real that Fish is playing in Vegas? Thanks, Casper Rope Access. Peep snow if I get a chance. I just did Apple for you, Sam. These tickers are all running together, aren't they? Year-end recap. I just looked at my recap for the year. It's been a great fucking year, man. I want to thank all you guys. Dude, the number of unique visitors and watchers this year is insane. I think on YouTube we had 350 or 60,000 unique viewers. I haven't looked at Twitch yet. The stats for this year for us have been amazing. Insane stats this year. So thanks and congratulations to all of you out there. You want me to look at BTC too? We were talking last night. I was talking to Quinn last night about having a dedicated crypto just what we do is, or what we do. What we're talking about last night with crypto is we're saying, I was saying, I was like, I'd really like to focus on crypto, but it attracts so much noise. How do we not attract the noise but attract the real crypto? There's like an underground. Very crypto bros probably know this. There's an underground crypto community that's no one covers. Very small communities. So we're talking about that. How do we tap into those communities? Maybe cover those trades for those people. So we're discussing that late night last night, and I'm hoping we can do that. You want to take a look at BTC really quick and Snow? We'll look at both of those really quick. Let's take a look at BTC and Snow. This is the triggers. We'll check out BTC. We had a little conversation about BTC earlier this week. Talked about bounce on Bitcoin. On the daily trigger, we talked about this earlier in the week, if you recall, to not expect this to break. Okay, we'll put this on a 30-minute so you can see it better. Let's talk about this. I think we even made a post about this. People were like, "Oh, crypto's crashing, it's burning, BTC's burning, it's gonna be terrible." We were like, "Yeah, I'd be looking for a dip buy down here." We got 1, we got 2, we got 3, we got 4. We're now above the hourly trigger currently. Now, I want to be clear with you, okay? You are going to be looking for, number 1, a 3-hour look back on Bitcoin or any ticker. 3-hour look back. This is very bullish. You get your squeeze, and you're getting your cross right now, the half-hour and hourly trigger. But what you want really, if you're a bull, is for a touchback, okay? On any squeeze, a touchback that's successful, and that actually leads to much higher prices. So, these initial squeezes I never like, and the higher they go, the less sustainable they are. So it's a pretty big squeeze right here. We're coming into the first resistance point. You've got another resistance point, and you've got some higher. But if it can come back down and check and have a successful check, we should have an explosive move to the upside on Bitcoin. So let's look at this on another basis here and just see what we're looking at here. So we tag this one here. I'm going to expect a move down, move up, move down, and then that tag right there. And possibly right there. That's all I'm going to give you right now on this turn. And I would expect after this to be grinding to the upside. I don't think this is top, by the way, this 44,000. I think we're going to a much, much higher high. But then thereafter, you've got these sellers above anyways. These guys are trying to tell you no. So I would not have another trade until we got above it. Or I should say, I'd really like to see from that point some consolidation here, and then we'll start talking about higher highs above this one here. I'm not really interested in this part of the trade. These sellers are going to try to come in and slap you down, but I am interested in this up here. This trade I like here. This is no problem. And as long as we're above, as long as price remains right now above 41,311. 58. The upward trend is in play right now. That upward bullish move to come back here and at least see all this stuff. Now you get the double top above here. So I'm interested in that over here, but this up here, I'd really like to see this happen so it's not a double top. We can get above and continue that run higher. What was the other you guys wanted? Snow? Snowflake coming into its monthly trigger. We know that when price is below its monthly trigger, it's negative. We are swinging up, though, into its monthly trigger. This is a 30-minute chart. And we have a 5 trigger cluster here that's growing. I do like it, the ticker here. I like the accumulation that's going on down below. I would really like to see these. As a matter of fact, you got another ticker right here. The next week or two here, snow should get violence to the upside. And let's take a look on the daily. All gorgeous structure. Price target on snow, dude. You guys are looking to mess around in this ticker, aren't you? Target 220. Next target to the upside. I mean, you got them all over the place, right? You got another one right here. You got another one right over here. Another little guy right in there. And then you got another gapper right here that needs filled right in there. That's like 325. So you are moving. You are getting extremely bullish here. Whatever push up you have, remember that daily trigger. Come up here, grind, grind, grind. You're going to be looking for the daily trigger and the weekly trigger as we consolidate in here to start to push you to these extreme highs. I really like snow here. If you're a snowball, whoever called that one out, I really like that ticker. So this is good. Now remember, we have to get above this monthly trigger here. Anything below is still bearish, but once all this momentum comes from the downside to the upside, we should rip to the upside. So I like snow here. I'd be monitoring this. Any chance that you have to buy a dip on this ticker? You want some exact targets? 174.90, 174.85. I'd love to buy that right there. So there is my buy zone, 174, 180. And you'll get this like grinding action. As every day we move up and up and up and up. And eventually we will explode to the upside here. If at any point we break above, show you this too. If at any point we break above 193, right? If we actually get able to break above and hold it and start heading higher and break these prior highs, I'd be long there as well. So keep your eyes on 193 as well for a beginning of a squeeze to the upside. Let's go back to the main screen. January 2022 high 467.13. Oof. I want to short SPX into the ground. Fuck yeah, I do. Like if I'm thinking about somebody just said, "You want to short SPX?" Yeah, like I'll be honest with you. I've got my Main Street hat, right? And then I've got my trader hat, and then I've got my emotional hat, my brain hat, or not my brain, but my heart hat. And yeah, let's look. It's a good question. Why do I have the feeling of wanting to short SPX into the ground? Let's talk about that right now. So we had the 6th highest. Here, give me one quick second here. I'm going to show you guys some stuff here. So this isn't what I think's going to happen. I trade what's in front of me, but I know, or I think, that I'm not the only person out there that wants to short this shit into the ground. Now, that doesn't mean 3,500 or anything, but 1, 2, 3, 4, 5 days of some just cooling off in blood. I think that's a sentiment that's pretty. If you're a trader, if you're like a supply and demand side trader, not a bull or a bear, you're probably at a point of wanting to see that happen. Then there's this whole other group of people that buy and sell spreads, fly holders, sellers, straddle sellers. They're all in pain right now. So they're just begging, hoping. You got vol people out there getting crushed. Give me one quick second. I want to show you guys something cool. Give me one quick second here. This was I got a cool one for you. So I was chatting with, or I made a comment. I had made a comment 2 days ago or something, or I think it was 2 days, yesterday or the day before, and I was like, you know what? I looked back to 2012, And the higher we go here, how it ends is usually in a fast correction, big one, big correction. And it's really fast. Then yesterday, what did I see? I saw something yesterday that was let me see if I can find this, what I saw yesterday. Hang tight. Let me see. What did I find yesterday here? The sixth highest. Give me one quick second here. Implied SPX Daily Gamma finished at 1,300, the sixth highest amount on record. Sixth highest amount on record. And it kind of aligned with looking back in time of the readings on the daily velocity on SPY. It's very rare to see our velocity as high as it actually is. So we're going to look at that right now, and some prior historical examples of what happens. So we have this huge high reading right now, right? And then also the daily velocity is giving us readings that is very rare. It's just not that common. So we're going to let me see if I can take a look at this right now. I'm going to set this up in the background. Give me one quick second here and see if I can set this up for you. So is it what I think is going to happen? I don't know. I don't really care. I'm hedged, so if we go down there, we go down there. But we're going to take a look at what we're talking about here and just see if we can take a look back here. One quick second. I'll mark some of these off for you. How many are you going to mark off? How many is enough for you guys, I wonder? Let's see if we can chat about this really quick. Okay. So I want to show you a few things here. And I apologize that all this is here. It's kind of hard to see, but what I really want to show you here is these readings. So let's take a look at this one right here. And what we're looking for here is daily velocity. And I want to show you that how high this daily velo is right now. And we don't have too many examples of it in prior history. Here's one right here. This was the top. That was the big boy right there. We had declining weekly velocity. We had a peak in quarterly velocity, and then we had a even bigger tell after once we got in here. We were peaking out. This is when we're topping on quarterly, monthly, and weekly velocity, and we have declining weekly velocity. These things right here are a indicator of declining under the surface velocity, even though price is not showing a role in the marketplace. Okay, this is bad. Okay, notice the weekly velocity right now is actually declining. The quarterly is at 0. There's some accumulation down below, so whatever that roll is going to be, probably doesn't look like a crash here at this point. Doesn't look like one. Looking in prior history here, we had increasing weekly velocity, but so we had a little bit more squeeze higher, but then we had a major crash, right? Here's one from January of 2018, major pullback. I'm going to show you a couple more back here. We had grind over here. Here's one right here, right? And we ground. Let's take a look at that one a little bit closer. We had some quick blood, You can see it right here, just quick bloodbath down, grind, but then a blast down later on. We have another one right here. We had this. This is the one that everyone's on right now, right? This is the one that people are talking about where we just blast up, slap that 470, and then a big pullback right here. Tag the monthly and just keep on moving to the upside. This is not really the same here, right? Can't really call it because we're actually declining on the weekly. So we have probably less of that is a possibility than the declining weekly over here. Here's another. This one's kind of inclining, but this one right here is a little bit closer. Push up, blast back down, and then we to the weekly trigger, and then we grind and eventually roll down one more time. So that's pretty much closer. Anyways, what's really most important about this chart right here is when we're peaking on this daily velocity to expect some kind of a pullback. When that pullback is, I can't tell you. I don't have a crystal ball or anything like that to tell you guys where the roll comes or when it comes. But you know, the sentiment out there is more of what I'm thinking. I'm looking for retail sentiment when I make those statements, right? And I'm like, hey, I would love to come in and short this shit down in the depths of hell, and then check the comments. Who's responding? Is it bears responding? Are they in pain? Is it bulls responding and they're just like, yeah, get us a pullback? Or is it bulls that haven't ridden this up and just keep waiting for a pullback? They're not in the market right now. So that's the reason I make those posts on FinTwit to find out sentiments from retail traders, especially when we have declining velocity right now. As a matter of fact, let's go back to that chart. So just so you can see this right here on this daily velo, even though price is careening higher, what can we tell here? And that is this velocity is starting to wane to the downside. So there's a divergence right now in daily velocity and price on the stonk market. So I'm fascinated by it. The mechanics here could be really fast moving markets in the coming days, next 2 weeks, and even into late January. Yeah, you're watching it too, Anthco. I'm very fascinated by what takes place and how fast this could move. I'm scared that people could be on the right side of a trade and it reverses on them, and they get blown out for being on just one side of that trade, not being hedged, not being just not closing at the right time, rather than reacting. I think this is a good time to be on the reaction side of this trade and not necessarily on the follow of this trade. Like, hey, I'm going to follow this all the way up and not be hedged, and I'll be able to close in time. You could wake up tomorrow and the shit's on fire, right? So you either have to be hedged chasing this up, or you sit on your hands, you wait for the roll, and you get in on the roll side of this trade. Yeah, brother, I see it, bro. I see it, man. I've been watching. I don't want to say much about it because I'm like, I don't want to be a doom bear and all that kind of stuff. Too many people pay it. Like, too many people. It's not like I don't like have 100,000 fucking followers, 1 million followers, but you know, people watch, and anything you say is taken as you're like writing a fucking Bible for people. Another thing too about people is you'll give them both sides of the coin. You'll be like, hey, this can happen and that can happen, and they fucking latch on to whatever narrative feeds their thesis or their positioning. But that is happening in the background. So like in the background, Anthco. Anthco, man, underneath the surface, there's some stuff going on back there. There really is. So, and I don't know when it happens, man. On the 15th, we lose a bunch of gamma. On the 15th, it's not necessarily a moment. It could be a moment of weakness or an opening the door to higher. Everybody knows at this point, right? The indexes are tied to an underlying ticker symbol expiry on late January. I thought it was the 15th, but I guess the 19th. I think we've got expiration on the 17th of January. That could prop the market up all the way into that January 15th, 19th. You guys know what traditionally the market does as well. Let me show you guys what the tradition. You guys want me to show you some traditional charts here? Hang tight 1 second here. I was going through SPX asset managers plus leverage money long short ratio this morning. Now we're gonna look at we're gonna take a look at what here. What am I looking for here? Not Treasury yields. Seasonality. We're going to look at SPX seasonality. See if I can get this up. And we are squeezing higher when we should be rolling down, right? We've got a divergence right here. We should be squeezing down. And they just said, fuck you, we're buying that dip and we're going higher, right? Starting the holiday run early in here. Though we tend to, over time, kind of track where we're going, right? But we can get outsized moves in the market. Past 2-3 years, we've had volatility up and down. So even though we have this divergence, we can and will likely pull back down or back down more in line with seasonality. But what I really like to draw your attention to is next year's expected moves, and this goes into the 21st trading day of 2024 for last year, right? Last year's price action, but look at the normal price action. We grind up typically into the 33rd trading day of the year. Now, seasonally wise, we usually get outperformance by IWM, whereas we have underperformance by SPX and NDX as well into March. But you should find another dip to buy and be able to trade this up into trade IWM up into an extension into late March, especially if we continue to pause on rate hikes. So there's your seasonality chart for you. Let's see what you guys got going on here. Hey, what's going on, Will M? Good morning, brother. Good to see you. Oh yeah, UNG, the Widowmaker. I don't trade those. I don't trade that Widowmaker stuff, man. Every time I trade a UNG, any kind of natty gas stuff, I'm like, this is money I'm never getting. It's trading UNG is like loaning money to your brother. Do you want to lose your brother, or do you just expect he's never paying you back? You can't really hold. You didn't exit. You're still in it. Right on, right on. There you go, Santos. How are you? Yeah, Santos. I'm in basically a straddle right now. I don't care where we go at this point. Let's move into the discussion about what we should expect into this rate decision. What the market's expecting for moves. There's some people out there saying that there are people out there saying there's a silent drumbeat of saying vol crush, IV crush. You're not going to see a lot of fireworks today. There's this opinion of that. We've had a lot of those rate decision days in previous history. All of our previous pause rate decisions, they like crush it, right? And they vacuum up at the end of the day, and then we get the move the next day or two after the actual event. So maybe we'll get more of that today. So let me look at something really quick here, where you get everybody all fired up, right? And we don't actually get an outsized move. So let's take a look. I want to see what the expected moves are on on SPY at least. So right here, just keep an eye on my cursor right here. Implied move right now, expected move is 0.5% up or down for the 13th. That's today. We got 467.14 and then 462.49. Moving into the 14th, we've got an upside target of 468.11, 461.56. The same thing on Friday, 469.42 and 460.19. I want to make a note to you that these expected ranges they're like toilet paper. They're as good as the paper that they're written on and can be burned at any time. These things move with price, these expected moves, what's being priced in. So we can always blast down here, and then you reform this this expected this dealer pricing for down the road. So just be aware of that it's only good for current price. But we'll look at this for today. We've got 467 and 462.51. And we'll mark those off right now. $467.14. And look at that. Let's see if we can do this with you guys watching here. Okay, so this is a Webull chart. Dealer implied move to the upside is 467.14. Or not dealer implied, excuse me. Options implied move at this point, right where we are. Upside move 467.14. Downside expected move on the day is 462.48. So right around there. So if you're a dealer right now, you're expecting no more than this move upside, okay, on the day. On the downside, the expected move right now to the downside is right down there on the day. So what we'll do here is, or what I would say to you here is that when this 2 p.m. comes over, let's mark this in. We got 2 p.m., right? You get the rate decision right there. And then we've got the presser at 2:30 right there. Right. So I would say to you that as we come into this 2 o'clock hour in here, if we hit this 2 o'clock hour, let's say we drag down here into that downside expected move, I would expect us to fail it. And then the same thing to the upside. If we get this upside expected move, maybe we can come up here, but then I would expect a failure. Repricing of options. And even if we're going to go to the upside on some good news, I would expect that up, down, reprice, then we make the move to the upside to try to break above this 467.14. But in all honesty, a lot of these events we've had, we've seen oftentimes the blood, the upside, and then a grind right into the close. Dealers come out, thank you for playing. You don't get the move down that you're looking for, and you don't get the move up that you're looking for. You get some failures in here, and we're all like, yeah, let's do this. And sure enough, they fail it just below the expected move. They fail it just below the upside expected move, and you're caught holding the bag. And then after all of this repricing that takes place, the real move comes tomorrow. If the market moves too fast for you on these rate decision days, I do really like, especially of late, I really have enjoyed. I've really enjoyed waiting for these violent moves to the downside to buy some calls, even if it's only for a moment. As we head back up here, and then I'll cut them loose, and then I'll get some puts in here, and then try to take that to the downside. So this is more of a reactionary move. Also, if you're getting all kinds of bullish as we come up, oftentimes once we get into the Jerome Powell presser, we'll see some pullback on the presser news and possibly the questioning that takes place. You can see some of that weakness in that actual presser. Then we might continue higher or blood down into the close and just close right down here. So just be careful of these two time frames. This 2 o'clock hour, this 2:30 hour, we'll oftentimes see resets as we come into that 2 o'clock and then 2:30 hour. I'll leave this down here for you so you can actually see it. We will have the presser and the rate decision playing live on the show today as well. What do you got here? Kendall said that the important thing that matters today is what P says about QT. I agree with that. I think that you guys want my take on this. I will give it to you. Jerome Powell, in my view, is in a corner right now. He has not raised rates in 5 months. Historically, if we do not get a raise at this meeting, we will not see another raise again, regardless of what he says to you today. He probably knows this. I'm gonna like Jenny Yellen this morning was saying that what we do is an art. You people that work for the Fed and for the Treasury Department have written accounts of their experiences and the smart people that surround these officials and how much data is given to these officials, and yet these officials still think they'll read that data and say, I'm better than that data. I have a feeling this is what we should do. That serendipitous human, that fucking humanness, man, that people have, right? That ego that people have. And so I don't know what data Jerome was presented with today. Yellen sounded quite dovish today, this morning, to me at least. But Jerome's going to come into this rate decision today, and he likely knows that behind the scenes, that if he does not raise rates, that this market has already began to move forward, pricing in this pause being permanent and leading to eventual rate cuts. And it's just waiting on him to say higher for or at least higher for longer. And those wheels should continue to turn and try to time about 1 to 3 months before we get actual rate cuts to send this market to the depths of hell. My non-trader hat, my Main Street hat, I hope that he comes out with a surprise 25 BPS rate hike today. I really do. I'll be honest with you. I want him to break shit. If you're a young person, you want him to break shit. You heard Yellen this morning saying we've had stabilization in rental prices for young people. You heard that this morning, right? You know what that means? They're in line with year-over-year inflation continuing higher. So that $2,000 for rent in the rest of America, it's going to still only go up, just more slowly. Those places in America that are desirable to live, like the Santa Monicas, the LAs, the San Frans, wherever it is, Vail, Miami, that $5,000 to $15,000, that's staying and will only now slowly go up. That's not really good enough for young people. So that's my Main Street hat. Okay, that's what I hope that he does. The other reason that I hope that he does this is because he resets. If he does 25 BPS today, he resets those big mechanical wheels moving in the background and buys him another 5 or 6 months for higher for longer. Now, my trader hat says we have priced in no rate hike and a hawkish Fed, hawkish talk. That is the most probable and likely outcome today, that you're going to get Jerome Powell with no rate hike. You're likely going to get a hawkish Fed, and he's likely going to try to talk this market down today. The trick for that is, does the market believe that? I'm going to be honest with you as a trader. I don't fucking think they will. I think they're going to price in no more rate hikes, and you are going to see the markets also force that hand coming into next year. You know that I've stuck with my thesis of we'll be cutting rates by October of 2024. That the unemployment rate will be racing up to that 6 and 8%, no matter what they do. trying to fudge those numbers. You'll likely see inflation come down into that 2% target, and we will ricochet off of it. You even heard Yellen this morning say that we should bounce down there at that 2%. She said that in her interview this morning. So it's a now, and if that happens today, you're likely going, if that happens today, you're likely going to see those wheels continue to move forward and bet against Jerome Powell holding rates past 2024, not cutting into late 2024. Now, what is not priced in today is what? 25 BPS? What else isn't priced in today? Not a hawkish Fed. I was asking short seller ST this yesterday, and I was being serious. Have we priced? I have that question. Have we priced in? Have we actually priced in no rate hike and a hawkish interview today or presser today? If he were to come out today and do a victory lap, that's not really priced in, is it? So if we price this in, we should be flat on the market on the day, right? So if we get 25 BPS, or excuse me, if we get no rate hike and we get a hawkish Fed, ultimately we should wake up tomorrow with all of this priced in, right? No big moves up or down. Stay on the trend that we're on. If you get Fed J. Powell today that comes out and has the green tie on and is going to take a victory lap, which Yellen is hinting at this morning, that she's taking not a victory lap, but she sounded pretty fucking, like, pretty dovish. I don't know if I agree with her, but she's pushing that narrative this morning on CNBC. So that might be a leak of Jerome Powell coming out in similar fashion today. I don't think it works anymore. I think that the market knows. I think the market's not going to listen a lot to him from this point forward. But that's his job, right? His job is to try to trade this market sideways until the election. Basically, not go too far down and close the door on anything lower than 3,500. And that's what Biden wants as well. So, and that whether that works or not, I don't know, but that's what I think. So I'm fascinated to see what this meeting is. Now, can he? That's the next question. Here's one that I haven't heard many people talk about. And that is what? That is, let me put this up for you guys so you can see it. The one thing that I haven't heard too many people talk about is when the next rate decision is after this one. It would be fascinating if he said no rate hike, but I'm going to keep raising data dependence, blah, 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 data dependence, all that other shit. That thing he does. But then he throws in something like, hey, by the way, we penciled in a rate decision in January. That could be not priced in, and that could be the sword that he needs to rattle, that saber that he needs to rattle, is to promise a rate decision in like January or something, and that could potentially arrest the market as well. That's my little. If I had like one little thing today that I'm looking for is, do they announce today or even tomorrow? Just say, hey, we're gonna have another rate decision coming up here really soon. Yeah, that would be that could be a nice saber rattle. Like I'm watching. Not only am I watching, but I'll be back here with you soon. Any comments on timing of cuts will be very key. I believe JP has said that in an event that it may not happen anytime soon. I hope they do 25 BPS. Yeah, at this point he can threaten, I guess. Just keep threatening as long as the market believes him. I really do think, though, man. I think he's done. I really do. I think he's done, and I think he just has to make the market believe him as long as possible. Getting skinny eating Denny's. What if he keeps rates higher for longer and market price and cuts in 2024? He can do that, but the market can run against him. Is my point. The market can kind of force him not only into rates, like dude, prime example is COVID, right? And even then, we continued down for another 2.5 weeks or something like that until he bounced off the quarterly trigger. So yeah, he can be forced into cutting rates. The market can force him into cutting rates. Yesterday we talked about the bond vigilantes as well. I'm not going to bring that up today because that's so far out, but what else we got there? Yeah, I got a bunch of those cheap puts. I got like fucking puts that are worthless right now, like penny puts just in case we roll down hard and heavy today. I missed your thesis here, Daniel. Let me read it. Hold on, brother. It's hard. I want you guys to understand something on my end. I've got 2 chats going, so it's hard for me to keep up with the chat. And then I've got another main chat that combines both chats, and it lags. So I apologize to you out there. Let me see what you're saying here, Daniel. Let me scroll back up, brother. Daniel S. is saying, Cap, why do you keep saying you want him to crash the market? The population will move around to cheaper areas. It's normal migration when people realize things are too expensive or the politics are. Why do I want the market to crash? That's a good question, Daniel. I'm older, so I know where those generational buying opportunities are. I saw one in October. But anytime we get major pullbacks, I am a bull. I like to buy major capitulations. I like to buy major resets in the market. There's an argument to be made that we're at that place right now. I showed you guys a forward PE ratio for S&P 500. We're bouncing right on the trend line right now to buy the S&P 500. I can see us going to 6,000 quickly, but any blood that we get, I like to buy. So let me explain my bullish position. I want to be clear about this. I'm a bull, okay? But I'm not the bull that's on Twitter going woohoo as we're at a top, a local top, a quarterly top, or any of that kind of stuff. I'm usually the guy that's out there trying to buy a bottom while the market is literally on fire. And most of my friends are the same way. We're looking to buy most of my friends, we're looking for the doom and gloom always, never the euphoria. So I welcome that stuff. That's the shit that keeps me from not having to have a job is doom and gloom. So whenever there's more doom and gloom, I love it. I can't stand tops because that means I'm exiting. That means that I'm not long in any way, or I'm exiting long, like underlying positions, owning the stock market, that kind of stuff, and looking for the next dip. So I'm looking for that generational buying opportunity, which we haven't had since what? We had a great dip buying opportunity in COVID, but 2008, 2001. So if that ever comes, I'm on it. I would love it. What else we got here? That includes like the housing. So I own houses. I mean, that includes the economy. It includes the price of everything. Resets are good, man. For short-term debt cycles, they're normal, natural. We haven't seen that reset of our short-term debt cycle in our economy yet, so that's what I'm more what I'm looking for. What else we got here? We all pass what we make onto our children when we die anyway, or pay for all of our children's stuff. The only people that lose when the market crashes are the citizens with money in it. Okay, so Daniel's making a commentary I like. He's saying, we all pass what we make onto our children when we die anyway, or pay for all of our children's stuff. The only people that lose when the market crashes are citizens with money in it. So, short-term debt cycles, okay? This is a fundamental aspect to our economy. What we do in our economy, okay, is we try to, or let's say, so in our economy, what we do, Daniel, is we increase and decrease liquidity, keep money into our economy, okay? This is a function of our government. Our government basically eases money into our economy and then tightens money into our economy. And why do we do that is the question. We do that because we want to see growth and we want to wash out people that haven't done what they're supposed to do with that money. So let me give you an example. So I'm a father, right? And I have children. I give $100 to my oldest daughter, and I give $100 to my youngest daughter. My oldest daughter takes that $100, and for 5 years, I give it to her 5 years, and I say, you have to pay this back to me, right? So my oldest daughter takes the $100, and she turns it into $500, right? And 5 years later, I say, I want my $100 back. So she gives me the 100 back, right? And now she's got $400 on her. She's excited. She's built a life for herself. She's got no debt. She's cash rich. She'll be fine. My other daughter, I give her the $100. What does she do? She leverages it. She might leverage it into some good stuff. She might leverage it into some bad stuff. 5 years later, I come back to her and I say, I need my $100 back. And she looks at what she leveraged that $100 into, and those investments are not paying out for her. They're like zombie companies, or they're failing companies. So I want my $100 back. She doesn't have it. What do I force her to do? I force her to sell these bad investments that she's made to pay me back my $100. She goes bankrupt in the process. I get my $100 back, right? Removing liquidity from the system, and I'm also removing that bad investment, bad investor. Sometimes they're just overly burdened with debt, even good debt. They're just hanging on though, right? So I remove her from that system. So what happens there? I wash out the daughter that is making bad investment choices, right? Cleaning up the system. I've got another daughter over here that's done a good job. She's going to make it, and so I've now tightened, right? And that's the part of the process that we're in right now. We're trying to tighten and remove the bad debt that's out there, the people that didn't do what they're supposed to do. And that doesn't mean it was for the right or wrong reasons. Let's say my youngest daughter was great, went to college, did everything, but she got sick, or she lost a leg, or it's terrible to talk like this, but I'm trying to use a vehicle here. Doesn't matter really what she did. I need to wash her out of our system so that I keep the cream of the crop. And then the next debt cycle, I go to put more money into the system, right? And I'm going to offer that $100 once again. Now I look at my daughter that did great. I give her another 100. Now the other daughter that didn't do well, what do I do for her? Nothing. She gets nothing. She's too old now. So where do I put that second $100? I actually give it to someone younger than her, maybe her daughter. My granddaughter, I go, here's 100 for you, right? And so the granddaughter's young, right? The older daughter that didn't do what she was supposed to do, she's washed out of the system. Now I'm giving $100 to this next generation. That's kind of the key point here, Daniel, is we have a new generation of young people coming into our economy, and you need to give them a chance to get a leg up in this next short or long-term debt cycle we have ahead of us. So that's the function of what we're trying, or what they're trying to do. Does that work or no? As a soliloquy, I don't know if that works for you. A simplified explanation. And now I know there's pain in that. I know you don't want to hear that. I know that it's not nice to say that. I know you're not going to hear Jerome say that. You're not going to hear Yellen say that. They're never going to say that publicly. But that is what they do. That's what they do. That's how our system, our capitalist system works. You might not like it. You might like it. You might think there should be more security in there. But that's a different thing. That's my Main Street hat. I'm a Democrat, man. I'll tell you, I'm a Democrat. But I got to separate those hats, like my Main Street hat versus how our economy functions, how our system runs, how the stock market runs. And so, and every other market, bond market, doesn't matter, housing market. And right now it's hard to say that, Daniel, it's hard to say that a kid can afford to buy a home and that their pay is going to be, in anticipating next 5 or 10 years, what do they have to make? 200,000, 300,000, 400,000? just to make it after college or trade school or whatever they do. And I'd like to see them be able to afford that stuff if possible. Carlo says, know you let her leverage it again. Yeah, if she declares bankruptcy, tries to hide it all, and she gets into that money again, right? And some of the reasons people, I'm going to say this too. My youngest daughter in this example, right? Just because they get washed out is not always because they've done something wrong. Some people so Daniel's saying, people get hurt in this process that don't deserve it. I agree with that. I was talking to Joe Donut last night, and he was talking about the crash of 07, 08, and he was like, my whole entire neighborhood was empty, unmowed lawns. I was the only one left. He's like, when I sold my house, he's like, it pained me to have to go through that process. And he took some hits on that process. So even though Joe Donut did the right thing, he still felt pain in that process. He was still sucked into that vortex of that short-term debt cycle that we went through in 07, 08. So yeah, even if you're doing the right thing, you can feel that pain. I don't disagree with that. Yeah, I'm a bull. So my point stands. I'm a bull. Whenever those resets happen, I'm ready, right? So Joe and I were talking about this last night, and our thing was, would you want to reset? And both of our points was, fuck yeah, like, I've paid my debt down. I've bought my houses. I paid my mortgages down to zero. I've done the right thing. So if the housing market were to crash, I'm there. I'm ready to buy. I've done the right shit. I suffered. I suffered paying my debt down. I suffered to be where I'm at. I went without when other people were driving around in a fucking $140,000 brand spanking new F-250. I had a few-year-old truck that I drove around. I didn't live like that. I don't look to my friends like I have the wealth that I have. To my friends, I look poorish on the surface. And I'm fine with that. I'm fine with that because I want that generational wealth. I don't want to get caught in that fucking debt trap that most people get caught in. I was caught in that debt trap for a lot of years. For a lot of years, it was paycheck to paycheck. Even when I did well, even when I made a lot of money, it was always paycheck to paycheck. It was always look good for other people. It was always that kind of shit. And for me personally, I welcome that stuff. So if it comes, I'm here waiting. You reset the housing market, I'm ready to go. Yeah, reset benefit savers, hands down. If you pay your debt down, if you save money, if you're you live frugally enough, those resets benefit those people, hands down. You agree, but you just don't want the value of your properties to decrease. I used to be afraid of that. I used to want to flip homes and flip homes. Today, I don't do that. I own 3 homes, and I'm happy. I'm happy where I'm at. I'm not a big slumlord. I just perfect where I am right now. I'm not concerned with my value going down in my homes anymore. Whatever those swings in the market is, I really don't care. I'm going to pass all this on to my kids if I can. If I don't ruin my life with medical bills when I get older. That's my biggest fear. If I had one biggest fear today, it's probably medical bills. It's the one that scares me the most. And I won't try to chase. I'm not going to try to chase this next generation either, as well. So I'll steer clear of that stuff if I can. Trying to keep up with the Joneses in Beverly Hills when I'm 50 and 60 and 70 and 80 and all that stuff. Do I think the economy is F next year? We have liquidity coming into the system right now. We have a vehicle in the inverted yield or 10-year yields to remove liquidity for the system. That shit ain't working, right? The only other vehicle right now would be a rate cut or rate increases, and we haven't raised rates in 5 months. So there's money creeping in the system. They're just not telling you. They did the same thing with the regional banks, too. Yeah, you got one two-family and a single-family, right on. They're doing fiscal stimmy right now. They inject money in the system right now. Been doing it all along. You can call it whatever you want to call it, but they've been saving our system for quite a bit of time. The thing that fascinates me is that the thing that we talk about this, right? Jimmy Barry and I talk about this, right? It's like buying time so that you can accept a higher inflation, buying time for wages to be increased, so that you can accept that inflation, and no return to previous prices in a lot of aspects of our lives. The older that you get, you see it. Price of a hamburger's never come back down over the decades, and you see it with eggs and hamburgers and whatever it is that you're out. Rent doesn't matter. So that's what, in my view, that's what they're doing. They're going to declare job done. We've got year over year 2% inflation, and your wages are coming up. They're going to do a victory lap, and you're going to see higher prices in 10, 20 years. You're going to be paying fucking rent that's way higher in 15, 20 years, in my view. Unless they pull a true Volcker moment, which I don't think that they have the political will to do. I don't think they have it. Well, wages are going up. If you don't know that, I want to tell you something. Some of the data is just starting to come out, but I do want you guys to be aware of something. Wages are coming up. If you're young, if you're older, matter of fact, it doesn't matter what age you are. I want you to know that wages are coming up. You saw renegotiation of wages for airlines, trains. You saw it for shipping. You saw it for FedEx, UPS. You're seeing it all over the place. All kinds of unions, auto workers, they're all renegotiating for an eventual increase in wages in the next 5 years to lead into 10 years. You see it in producers and pricing in every aspect of your life, right? So there's a pain moment in this, but down the road, wages will align in the next 10, 15 years to those demands and pricing. Well, it's not they make a 170 soon. I think that they start. I think they're on like a 4-year plan to make that money. Now there are going to be people that get wrecked in this, right? You're going to see. I was using this example the other day where I was like, let's say you have wages increasing over the next 5 to 10 years. You also have a company like McDonald's. And what they'll try to do is, matter of fact, here's another aspect too. We have 26 states have increased their minimum wage. We have another 24 states with legislation on the books for rating or for minimum wage increases. And then you've got companies like a McDonald's. They're going to try to raise your rate or raise your prices now and hold them, right? Max profit on this new debt cycle we're supposedly in. And then they're going to try to squash wages as much as possible because they know that their wage increases are coming in 5 or 10 years. They can't compete with those other companies like UPS for entry-level work, but they'll try to push or hammer down wages as long as possible until they actually increase. So, yeah, there's going to be some pain there in that time period for a lot of people. Well, engineers is a good point. So H-Bomb's bringing up engineers. An engineer pre-2019-20 was averaging about what, $90,000 to $100,000 a year. If you had a 2-family income, let's do some quick, easy math, right? Let's do like crayon eater math. We don't have to do much to get this math done, right? If you were a couple, 2 guys, you're married, two men, you're married, both engineers. Or 2 women. You're 2 women that are married. You're both engineers. You're both making about $90,000 to $120,000 a year, right? Let's call it $100K. So as a 2-person household, you're making $200,000 a year. You're pretty comfortable pre-2020, right? Let's talk about today. So today, let's say you both get transferred to California and you don't own a house, and you go to you've got a couple kids too, and you want to rent a house. House rentals start right now in desirable areas, $5,000 to $15,000. So you're making $200K a year. you have to pay what? What is that? $60,000 a year in rent after taxes. That's what, $80,000 a year you have to make. So imagine that. You're now at right around 30 to 50% of your dual income. So your wages need to go up, don't they? You probably need to make how much? And looking at an entry-level UPS worker being promised $150,000, that would mean that if you're an engineer, especially if you're young, you should be looking for no longer $120,000, right? You're now looking to make about what? $200,000, believe it or not, right? About 270, or excuse me, 175, 150 to $200,000, so that you can bring that 25% back down, or your housing back down to 25% of your income, right? So 90 to 120,000, you need to make 150 to $200,000 right now to maintain that lifestyle. What else does that imply, though? It implies that if you're an engineer and you're making $150 to $200,000 a year in the next 5 to 10 years, right? Are you actually living better? Probably not. You're living the same as you were making $90 to $120,000, right? Your lifestyle hasn't gotten any better, has it? So if that's the case, right, that your lifestyle is not getting any better and you're making more money, what does that make the stock market? Makes it really cheap right now, doesn't it? Extremely cheap. If money becomes cheaper over time, and you can already see that businesses are forecasting that, even though the Fed is telling you, or the Treasury Department is telling you something different. They're in your ear telling you that we're not going there, we're not going there, we're not going there. And you see companies already planning for that to happen. I would go with companies and not the Fed and say in 5-10 years, engineers probably be averaging on the low end 150 on the low end. And they're going to expect that and demand it. So if that's the case, what does that make the stock market right now? Dirt fucking cheap, right? Undervalued, to be honest, right? We're at prices not seen since 2022, 5-10 years. We're cheap, right? We should see that 6,000 with no problems, shouldn't we? Yeah, exactly, Thurston. Jimmy Barry's saying anyone that bought property in 2020 to 2023, you're about to get hammered. That Joe Dunnett last night was talking about rates going insane for some of those people, right? In the coming months. Well, maybe I think we might have Joe Dunnett on this morning. Can talk about it, but they got still some people in some variable rate arm shit too. So. What would happen if you cut rates today? That's a good question. If we cut rates today, I would expect a squeeze to the moon for liquidity to sell this shit into the depths of hell. And I would expect a fucking following bloodbath. It means we broke something, bro. Yeah, if I was an engineer right now, I would be seeking out new employment. If you're in whatever job you're in, you should be renegotiating. You've had an opportunity the past couple of years to do that, and I would be doing that right now. I'd be doing that right now if possible. Coming down into checking the half-hour trigger on SPUs. You want to know my positioning today? I've got a putback spread on the market that expires in June. I still have not cut the upside loose of that trade. I'm still on that trade in full at this point. I'm sitting on some 0-8 puts and 0-8 calls for whatever the move is in the market today, up or down. I really don't care. I should get a print more so than what I paid for the entire trade. What else? I'm looking for a move, though, today. One way or another. To that downside or that upside. I don't care. Hold on. You guys are blazing through comments right now. Let's see what you guys are talking about. I'm missing a bunch of comments. Another issue I see is that engineers and developer landscape is pretty saturated with workers right now, with so many companies laying them off, whereas entry-level and hourly jobs are dying for workers. The one thing I would say about this, that what you should see is you should see older workers that are overpaid get cut from the system. They'll get laid off, and then you'll be looking for those jobs to be filled with lower wages from young engineers. What else we got here? Grip it and rip it, tag it and bag it. Look at Rock, seeing that in my company. Darth Molly's saying 100% seeing that in my company. That's what I would be doing. You figure if you have a tighter job market, an actual tighter job market, I'd be trying to, like if I got some, this is horrible to say, because I'm this age, right? If you're an engineer and you're 50 years old and you're maxed out with pay, I really don't want you at this point in this part of the cycle, right? I want to hire someone cheaper, someone younger and cheaper. So you're probably going to get offered severance, a buyout, whatever that is, right around now. So I'd be looking for those jobs if possible. If you're young, and then if you're older, before this actually happens, if you can secure yourself a position with a higher rate of pay, beyond that too, make a jump higher in what you're doing. Cap, if you have small children, encourage them to learn skills. What job skills do you foresee to be the way of the future? So my children, I teach them a lot of stuff that kids miss today, like hands-on stuff. My daughters help me fix my cars. Believe it or not, my daughters, you guys already know I like ski, hike, bike, ride bicycles, all that stuff, surf. Like the touch and grass type stuff. As far as schooling, my oldest daughter is an honor student. She's very smart, stupid smart, and we just had a discussion recently, about 6 months ago. We're discussing college education, and what I asked her was, she wants to be a doctor, and I was like, it'd be great for you to get a medical degree in 4 years that you can get paid with immediately, and then make a decision if you want to go to medical school after that. Something tangible that pays. I said to her, I talked to her about becoming a anesthesiologist or something like that, right out of a 4-year school. I'd like to see her become a nurse or something, like a 4-year bachelor's as a nurse, something like that, then become a nurse practitioner. But she wants to be a doctor, so she'll probably not do what I want her to do. But skills and stuff like that, stay off the fucking phones. Stay off with the kids. Stay off the fucking phones. Phones are bad. Phones are terrible. iPad's terrible. Computer's terrible. When they're young, you want to get them out there experiencing real stuff. They look so awkward when they don't. You can see I don't know if I should say that, but yeah, I see kids that sometimes you're like, oh, that kid doesn't spend a lot of time outside. It's okay that they're awkward, but that's just what it is. So I want them to have that experience. They don't get sucked into that adult life of not getting outside. Private school or public school? So I moved to Detroit from a very nice place out west. So we don't have a lot of choice for schools here. So our kids are in private school. Both our kids were in private online, in present teacher prior to COVID, slightly prior to COVID. We already signed up for it because we like to sail, but that's how we got in. But we still do private school for our kids. It's a requirement here. I don't have a choice. Public schools here, not where they need to be. They're getting better. They're just still not where they need to be. You're never a fan of private schools inside kids going to school? Yeah. Even with private school, I'll be honest with you guys. I don't think even with private school, we spend a lot of time with our kids teaching them outside of regular school. I'm not even happy with private school. There's an aspect of there's this thing today with kids where everyone graduates, and as a parent, you got to spend that hour, 2, 3 hours. I want to say something about that if I can. If you have young kids, okay, these teachers are not going to tell you if your kid's falling behind. And my biggest fear for my girls is that, like, they get into 5th grade, right, and they just slide by. They're not causing problems for teachers. They're not on the radar of anybody. They start to fall behind slowly as their work becomes more complicated and progresses, and they begin to fall behind. And not until they're in 7th, 8th, 9th, or leading into 9th grade, do you find out that they're not prepared for high school. Now, I don't care what a kid's going to do in life. I don't care if the child's going to be swinging a hammer. I don't care if a kid's going to be a doctor. I don't care what you're going to be. But there's that base education for kids where you want them to have that. You want them to learn. This is a learning environment, right? It's a time in their life for them to learn how to learn, too. So that's my biggest fear with our kids. And the only way that I've found around that problem is that I care most about what they actually understand, right? So, hey, do you understand these concepts? If you don't understand these concepts, let's learn them together. And spending that quality time. It's great relationship building with you and your kids, and it is the difference. And it doesn't matter if your kid's smart, doesn't matter if your kid has a learning disability. You spending that time in learning those concepts, and for that kid to understand, that child to understand those concepts is huge, and a huge difference maker for them in life. It really is. Critical thinking is a game changer for a child, right? Teaching a child how to write an essay, like your school might review it with them and give them a passing grade, but how do you have to teach that to your own child? It's important, right? So they can understand how to form an opinion, argue against themselves, and then present their points for why something should be something. Be able to defend their thesis, make a thesis, defend it, address counter arguments against their thesis. All that stuff is important. I don't care if you're swinging a hammer. You still need that stuff in life. So anyways, I'm sorry for the rant. Now, I think parents are a key part. Grandparents, uncles, aunts, friends of the family, whoever that is, to have a place for that kid in their lives. It's important, and it's tiring. You guys see me; I'm tired all the time. I get pulled. My wife gets pulled. My wife and I, matter of fact, one of our close friends is Joe Donut. You're just like always running. It's always run from work, run from family commitments, house commitments. I don't know. Last night I was working on a furnace. Every year I got to do maintenance on a furnace or pay someone to do it. I was doing it myself. Late night last night. It's like there's always a fire somewhere. Money doesn't matter in that stuff if you really care about your family. It's all the same. You all put the shoes on the same way, pants on the same way, shirts on the same way. You're all taking shits the same way. Well, some of you make too much money and you don't do certain things. Some of you don't make enough money. You have to do more. You're saying they put baby kids in private school more? I don't know. My kids' teachers are not nice. They hold a pretty high standard for my kids. They have to work hard. It's brutal. Maybe it is when they're younger. My youngest daughter is now in 5th grade. My oldest daughter is now a junior in high school. So I got a 5th grader and I got a junior in high school. I felt like they were like that with my fifth graders, like my fifth grader before fifth grade, they were like that. But fifth grade, I feel like they start to have higher expectations out of them. Maybe you're talking about discovery. They have better discovery in private schools, possibly for kids. That might be the case. But I noticed that fifth grade, it's like we're on, we're live here. Your expectations are higher if you're a child. Yeah, he's in grade 6. You're tough on your kids. I try to be. My wife is tough on my daughters. I'm not. I don't know if that's a function of. I don't know what function that is. Daddy's little girl. I don't know. When I was growing up, my dad was hard on me. My mom was easier on me, and those roles are reversed with my daughters. I'm a little bit softer on them. I'll be honest. Yeah, same for you. Yeah, my wife is brutal. My wife does not fuck around with our daughters. Oof. like, it's like my wife is high expectations with kids. Yeah, you play. Yeah, exactly. Different roles, different people, different needs. The one thing I do notice in my daughters is that they don't want to disappoint me. I'm not hard on them, so it's weird. If they do something wrong and disappoint me, just the look on my face, it's like I smacked them or something. I don't even have to touch them. It's just like my wife's never touched them either. We don't do that shit to our kids, but for some reason, disappointment is just even if I'm not disappointed, just the thought that I'm disappointed is enough for my daughters. Yeah, parental approval. My wife and I just had a discussion about this the other day. What we'll do, what we're willing to do as they become adults, and all that kind of stuff. I'll always be there for my kids. We play family. Like we're not just mom and dad. We involve our kids in everything that we do. We made that decision. We had them. We wanted our kids in our life. We wanted to show them how life has been for us. So we include our children in most things that we do, incorporated our kids into our lives. Okay, so they're parking it right now. Not too much going on. 12:46, awaiting a decision at 2 p.m. We're going to make a trip around the market here and take a look at some of the sectors. We've got HYG squeezing up on the day. Still looking bullish on a 15-minute basis. Though we do have a roll on the 1-minute basis, we do, just a heads up here in this roll, we've got a bear plane on the 1-minute trigger. We have a giant gap down below to close at 75.85. The VIX on the 15-minute is looking quite bullish. On the 1-minute, squeezing higher now, trading $12.40, telegraphing the volatility into the market today on the rate decision. We've got Apple blasting down, trading 195, 58 seems like it's waiting. Dixie on the daily chart looks like it's awaiting the decision as well. NASDAQ trading 16,374, I believe. I'm getting old. My eyesight sucks. They've got a gap to close down below to 16,340. Looks like there's also a buffer on NASDAQ as people want to see that 16,000 level hold. So downside expectation on NASDAQ today looks like 16,000, possible 300-point move to the downside as a buffer. TNX looks like it's sitting there parked, awaiting a decision as well. So not too much to read here. Looks like the market is just getting positioned for Jerome Powell today. So I don't see too much here in the background. Some news. Wall Street saw only minor movements up in the market, run up into the Federal Reserve decision with the disappointing inflation data reinforcing speculation that policymakers will be slow to declare victory. While markets remain confident that officials remain on hold on Wednesday, the latest data calls into question the aggressive pricing of a dovish pivot. Traders have slightly reduced their bets on rate cuts in 2024, with the first still expected in May. The data also fueled speculation that Fed Chairman Jerome Powell will try to deflate the Fed's easing buoyancy. Following the last rate decision, Powell reminded investors that inflation will come in lumps and be bumpy. The fact that Tuesday's consumer price index was roughly in line with expectations and ticked up slightly highlighted the choppy nature of returning prices to the 2% target, particularly in the service sector, which the Fed has targeted as the final mile in its inflation fight. Key point here. I'm going to read that to you one more time. Following the last Fed decision, Powell reminded investors that inflation will, quote, come in lumps and be bumpy, end quote. The fact that Tuesday's consumer price index was roughly in line with expectations and ticked up slightly highlighted the choppy nature of returning prices to the 2% target, particularly in the service sector, which the Fed has targeted as the final mile in its inflation fight. So that should be something you should be aware and keyed into in the coming months ahead. After spiking in the aftermath of the CPI report, 2-year yields have stabilized above 4.7%. Long-term treasuries rose slightly after a $21 billion sale of 30-year bonds drew strong demand. The VIX, the Wall Street's fear gauge, fell to a 4-year low. Yeah, I want to see a trader podcast saying, you know what I'm really excited about? New video of J Powell as base for deepfakes. Hells yes. What else do we have here? I'll read some more stuff to you. That's Asian stocks, UK GDP. Let me see if I can find anything else for you here. Yellen this morning, some highlights from Yellen. She had said this morning, I see a consistent pattern of inflation coming down over time. I expect inflation to continue to come down and inflation rates beginning with the numeral 2 by end of 2024. Did you read that? I expect inflation to continue to come down and inflation rates beginning with the numeral 2 by the end of 2024. She also says we are likely to reach inflation in 2% range at end of 2024. That makes sense to me. If we get inflation down to that 2%, we get unemployment up to about 6 or 8%. We should be front-running the rate cuts into the end of 2024. That would mean maybe a 2 or 3 month head start in June or so, June or July, to start looking for that front-running. There are risks on the horizon, but I don't see the risk of recession as particularly high. She also says the Biden administration is likely to revive proposals for higher corporate tax rates next year. That's an interesting point. That's another sign of the tail end of a short-term debt cycle, where the government attempts to remove more money out of the system by taxing corporations. You usually see 3 or 4 of these signs. The first one would be civil unrest in your country. The next one would be taxing corporations, and the other one would be war, or the possibility of war, a war proxy through other countries. We know that we have proxy wars raging around the world. We know that we've had civil unrest in the United States. So these higher corporate taxes are not unexpected. What else do we have here? The Middle East war has the potential to affect the global economy if it expands, she says. That's hinting back to that war talk that I just spoke to you about. Then that's all I've got for Yellen. Apple is set to be hit by an EU antitrust order in its fight with Spotify. The SEC votes 4-1 to adopt new central clearing rules for $26 trillion U.S. Treasury market. And NATO increases its military budget to $2.2 billion. That's all I got for you right now from that news source. Again, today We have the FOMC rate decision at 2 p.m. We have Fed Chair Powell presser at 2:30 p.m. Do not forget that tomorrow morning at 8:30 we have claims. We have the import price index. We've got U.S. retail sales and minus autos as well at 8:30 in the morning. We have inventories at 10, business inventories at 10 p.m. Then Friday we've got the Empire State Manufacturing Survey, industrial production and capacity utilization. Next week we have home builder confidence index on Monday at 10. We have housing starts and building permits at 8:30 on Tuesday. So that's that whole discussion. You see people discussing the housing market. So we have some big news on Monday and Tuesday on that. And then we've got existing home sales on Wednesday as well. Then we move into later in the week next week on the 21st, 22nd. We've got claims, GDP, Philly Fed, leading economic indicators, durable goods on Friday, PCI, PCE, that kind of stuff into Friday of next week. So we've got a little bit of volatility heading into the 22nd. Give me just a moment here. I'm going to take a quick break as we head into the 1 o'clock hour. I need to set up a feed so we can get the live presser on the stream here. So I'll be back with you guys at 1 p.m. The stream will stay up and on. Feel free to discuss and chat. And give me just about 5 or 10 minutes. I'll be right back with you guys.
All right, what's the setup, Joe? Adobe reports in OT.
Setup on Adobe.
You with me?
Yeah, Steve
Okay,
makes
Adobe.
me laugh sometimes.
Adobe.
Apologize. Generative AI. Has to be the story. Firefly. When is it going to be monetized? 2024. Conservative guidance might be what holds back the stock from advancing to the November of 2021 high at 699.
Bryn, you say you wish you owned it.
Yeah, if you actually go back decades, most stocks don't even outperform the 90-day T-bill, much less the S&P. Adobe, Costco, there's a few names. I mean, Adobe has recurring revenue. To Joe's point, they're in the thick of AI, which they will monetize. And so they have this flywheel that I think they'll continue to be a winner. I own the Qs, so yes, and it's in the top 10, so I own it. But I would love to have owned this name years ago.
All right, finals right after this break. We got a big closing bell, of course, right after the Fed chair finishes with the news conference. Jeffrey Gundlach of Double Line is going to join us in a CNBC exclusive. It's our last visit of the year. Very much looking forward to what he has to say about what might happen today and what could happen next, most importantly. So we'll see you at 3 o'clock this afternoon. Josh Brown, Liz Young with me, too. Bryn, what's your final trade?
OILK. It tracks the front month oil futures contracts. It's a trade only. If it doesn't work out in the next month, sell it. It's K1 free. And I think oil's at technical support, so it could get a nice bounce over the next few weeks.
Thank you. Steve Weiss.
I'm riding momentum, and Humana. It should recover everything it lost.
Surratt.
Amex, I think you're going to see much more spending from millennials going to help it.
All right. Joey T.
In honor of my good friend Stephen Weiss, Eli Lilly continues to push higher.
Okay, so we got the S&P, we got the Dow, the NASDAQ are higher. Yields, they fell today, all leading up to what happens in just a little bit. The exchange is right now.
Thank you, Scott, and welcome to The Exchange. I'm Kelly Evans. Here's what's ahead this hour. An hour from now, we get the latest Fed decision on interest rates. Stocks are in a holding pattern, as you can see ahead of that announcement. Dow's literally up 15 points. Bond yields are slightly down, though, especially after that cooler-than-expected producer price data this morning. The market is pricing in a full point of cuts next year as inflation has receded rapidly. Will Chair Powell push back on that today or not? Let's start there with full team coverage on the economy, the consumer, and the trades connected to the Fed's actions today. There's our whole roster of guests. Let's start with CNBC senior economics reporter Steve Leisman in Washington. Steve, what's the scuttlebutt?
Well, I think the Fed meeting today pitched the market's desire.
So I'll be back in just a few minutes, not a full hour. I'll be back just a few minutes. I got some stuff I got to set up in the background.
So it'll probably leave in the statement the language where it's been signaling its bias to hike, saying it's still, quote, determining the extent of additional policy firming that may be appropriate. It'll keep that even while it's going to have been on hold for 4 months through today's meeting and 6 months until that meeting happens in January. It signals its neutral, its bias to hike in that, but it also signals its bias to hike in the rates that the dot plot that it has. 12 had forecast an additional rate hike this year. Some of that may go away. 13 forecast cuts from that level in 2024. Average cuts of half a point. Some of that may go away as well. The trouble for the Fed is inflation is falling everywhere, but in that core CPI we got yesterday, it's falling globally. It's in today's PPI, and it's already prompting forecasters to predict progress in next week's PCE, the Fed's preferred inflation indicator. All that's to say the market expectation for cuts is also data dependent. They're looking for a 46% probability of a cut in March, 81% come May, and darn certainty in June with 95% probability. The market's willing to bet that eventually the Fed and Chair Powell see what it sees about inflation. There's time yet for the markets and the Fed to come together on all this, and even a grudging acknowledgement maybe today that if everything goes right for several months, then yeah, the Fed will cut. We'll see, Kelly.
I'm looking, Steve, for the date on when we're going to get PCE. Could this be right? December 22?
December 22, yeah.
Okay.
Part of that data dump that we get before the holidays every year. You remember that. So the economics reporter cannot take their Friday off before Christmas.
Never. And I think the significance of that, a couple of things. Number one, PPI this morning has everyone revising down what they think that all-important reading will be for the Fed. And as Nick Timrose kind of points out today, core PCE, which we call it the Fed's target, is 1.9% over the past 6 months already. So you could argue they're below target.
It could be. I mean, next week could come in right at that 2% target. We'll see. Even for the year over year, forget the 3-month annualized. It could be lower than that. The other thing I've been looking at, Kelly, I know you want to get to the panel, is look at a CPI ex shelter. It's down below 2% for several months now.
Wow. Interesting. All right, as you said, let's do it. Stay with us, Steve. The market is hoping for both a soft landing and rate cuts next year on this falling inflation, but how likely is that to actually happen? Sarah Eisen asked Treasury Secretary Janet Yellen, the former Fed chair, about that earlier on Squawk on the Street.
My baseline is that we'll achieve a soft landing. Are there risks? Of course there are risks. We could experience another global shock that could be unsettling to that path, that could jolt inflation upwards or have adverse effects on the economy.
Well, one of my next guests still sees some bigger risks than that and is calling for a recession in 2024, maybe a mild one. Let's bring in Subhadra Rajappa, head of U.S. rate strategy at Societe Generale. We also have Stephen Whiting, chief investment strategist at Citi Global Wealth Management Investments. Welcome to both of you. Subhadra, you guys have the recession call?
We do. We have a recession penciled in for the middle of 2024. And I think that we think that it's going to be a mild recession, and the Fed is probably going to have to act aggressively starting as early as the May meeting. We have about 150 basis points of cuts penciled in for 2024 and more in 2025. So we do think that this ultimately might end up being a very normal usual type of rate cut cycle. And, in this sort of context, I think that the Fed probably sounds a little bit more hawkish. There's no rush for the Fed to suggest that they're going to cut rates. So we're pushing back on the market pricing of cuts for the March meeting, but a May rate cut seems very possible.
Steve Whiting, I missed the CPI data yesterday, but I heard people saying it was a little bit on the hot end. Again, talk me through that. Is that report carry more weight? Do you think it could be a really dovish PCE report that could be to come? And let me just point out, this is going to break our new graphics back there, but the 5-year break-even inflation rate, 2.08% right now, Steve Whiting. That means the market almost has them missing their target to the downside right now before we even price in any real economic slowdown.
Other than the recession call, we're all talking about really highly tactical, tiny little insignificant shifts in the history of the story that we're going to be tell. I mean, central banks generally cared about inflation targets and whether they hit them over the course of a decade. Let's look back at the period after the global financial crisis. Well, we were below target for that decade. Now they're talking about whether or not we should adjust monetary policy a little bit up or down based on a CPI report. I don't think that that's really what's going on. So we've managed now to take inflation from 9% at the headline level down to 3% at a headline level, and there have been no jobs lost. And the labor market has shown signs of easing on the margins. I've lost 3.3 million job openings. But by and large, again, this has shown that supply shocks, upheaval in supply and demand mismatches really generated the inflation the last couple of years. Now, we can talk about the economy, but does the Federal Reserve need to punish the economy?
Stock indexes,
does
pair
it
gains,
need to force up the
flat.
unemployment rate to get the inflation rate down to something that will look like target in the next few years? And we don't think that's the case. We think that the case is very clear here that a slowing in the labor market will be enough for them to move off of restrictive monetary policy a bit towards neutral. I bear in mind in 10 of the last easing cycles, the Federal Reserve cut rates while employment growth was still positive, and the 6-month average was 146,000 jobs in that whole period. We're including the Volcker Fed.
So, Steve, why don't you just follow up on that real quickly? What do you think Powell's going to try to say today?
Well, I think he's going to say the Fed is still uncertain whether they've tightened sufficiently to guarantee that they will meet their inflation target. And it's, of course, as Steve Leisman just said, again, reinforcing their recent message. And all of that is fine because they can never be absolutely certain that they're going to hit their inflation target.
Right.
But will he also, in questioning, again, entertain what does it take? Why would we be easing monetary policy without a collapse in the economy?
Right.
What will it take to protect the economy?
I think, though, Steve Leisman, that the market's off to the races, and that's kind of what I was saying there with that 5-year break-even, which is extraordinary. They're pricing in a point of cuts next, and they're not even really pricing in an economic slowdown. This really seems to be a disinflationary loosening.
Yeah, I mean, didn't Taylor Swift sing "Dove's Gonna Dove" or something like that? I think those were the exact words that she used. The market's going to price in what the market's going to price in, and I think, as I tried to indicate in my report, Kelly, I think they have a basis for it, that when you look into the data, that there is reason for them to believe the Federal Reserve will cut rates. And in a sense, it's kind of funny to say this. It's almost academic if Powell acknowledges it today or not. If you
we have posted out a U.S. interest rate prep document on the feed for all those interested.
The pause, the rate hike, and then the pause, and then what'll amount to another pause today, and the next time you're going to have an input is the end of January. It's going to be at that level where you would think for 6 months or so, if you're at a level, you should be at least close to being confident you're at the sufficiently restrictive level. So let's call it what it is. Let's call it neutral. That's where the Fed is right now. I don't think there's any reason for it to be hiking anytime soon, not if the data break the way the data looks like it's going to break, especially because of the basis effects we have coming up. Now, the question becomes, I would note that Subhadra used the verb penciled in the recession. She did not use the word penned in the recession or etched in the recession. The question becomes, why does the Fed cut rates next year? And that'll be critical to the magnitude of the cuts that come. If the Fed is cutting rates because of the penciled in recession, that's another amount, and I think she already said 150 basis points, but if it does so because it needs to get less restrictive relative to the economy and not do what Stephen Whiting talked about, which is to punish the economy, then I think we'll have a more modest set of rate cuts next year.
Yeah, Subhadra, the rate cuts when we have that's the easy call. The downturn, we all, that's an easy script for the Fed to kind of use. The much more tricky one is the rate cuts without the downturn. And look, we all here have been talking endlessly about how inflation rate falls, they can bring down the Fed funds rate. Is that really that hard to explain to the broad public? Why shouldn't they go ahead and do that?
They could. They did it back in the 90s, and Greenspan was able to orchestrate a soft landing. But it's very unusual, and you just don't know how things are going to play out. If you look at, as you were mentioning, inflation break-evens have come down. Core PCE is starting to trend down quite meaningfully. Let's say by the middle of next year, we're at 2.5% core PCE, and the Fed funds rate is at 5.5%. At that point, it gets, very obviously in restrictive territory, and there could be a case made for the Fed to adjust policy, even if employment doesn't crack meaningfully. I mean, we do expect employment to slow down in the first quarter quite meaningfully.
Subhadra, let's put it slightly differently, which is to say, this is a Fed that has almost the perfect situation right now. If they don't act, they're going to ruin it because they're going to move us into restrictive, like a 3-point restrictive policy is historically extremely restrictive. If they do nothing, we're heading in that direction.
Yeah, and they want to mostly see inflation durably head towards that 2% inflation target. I mean, core PCE is still between 3 and 3.5%. Yes, it's trending lower, but they really want to see that get towards maybe 2.5 or anywhere between 2.5 and 3% before they cut rates. Because the last thing they want to do is to cut rates prematurely and then find out that inflation is starting to rise again. I mean, shelter inflation is still relatively sticky, although the rest of the basket is coming down nicely. So I think that they really want to see inflation durably heading towards at least 2.5% before they cut rates.
It could just be, and I'll give you the last word, Steve Leisman, before we let you go. It could just be a while. Maybe it won't be a while. maybe the data will move in that direction, but it could be a while before we get the kind of prints that would really give them the confidence that they're looking for around 2.5% or that range.
I'll give Steve Whiting the last word. I just want to say just very quickly, Kelly, that I don't think the market and the Fed are that far off. I think there's time for them to come together, and I don't think they're on different pages when it comes to the reaction function. I think if inflation slows meaningfully for the next several months, the Fed could be talking about springtime or early summer rate cuts.
If inflation is, all right, maybe springtime. And Steve Whiting, then give us kind of the wrap on that.
So look, I hope Steve Leisman is right, again, that the Federal Reserve is on board for some easing of monetary policy, not forcing monetary policy to tighten, right, and to interact and cause a deeper downturn in employment. But the one thing that we all keep talking about is recession is this fixed thing that always behaves exactly the same way. The economy is behaving unusually right now. We're seeing a strong labor market and a lot of industries contract. Well, there's a difference coming ahead. And even if it doesn't fit this perfect recession scenario that everybody can trade in and out of the market, out of it, the Federal Reserve should still react and do what their dual mandate suggests, and that's protect the labor market and slow inflation.
All right, we will leave it there, everybody. Thank you. It'll be an exciting hour. Subhadra Rajappa, Steve Whiting, Steve Leisman. We'll see you shortly. Coming up, mortgage rates have dropped nearly a full point in less than 2 months, enough that some homeowners are able to refinance the unlucky ones who bought at the highs, but doesn't tip the scales for the broader housing market. Moody's chief economist Mark Zandi will join me with his view as homebuilder stocks continue to hit new all-time highs. And as we head to break, here's a look at the markets. We'll call it a holding pattern. Dow is literally about unchanged. S&P up less than a point. NASDAQ down 10. 10-year yield right around 416. About 46 minutes to go until we hear from the Fed. The exchange is back after this.
This is The Exchange on CNBC.
Shortly expecting the results of the Fed reverse repo operation. Pound dollar falls 0.5% to 1.25, the lowest since November 23rd. $95 counterparties take $823.329 billion at the Fed reverse repo operation.
Welcome back, everybody. The rate on the 30-year fixed mortgage almost dipping below 7%, as you can see there, but we're still slightly above that right now. Borrowers taking advantage of that recent drop, with refi applications actually jumping 19% last week. Demand for new mortgages was up slightly, still down 18% from a year ago, though. And my next guest doesn't see a meaningful turnaround in housing until rates are below 6%, and he doesn't see that happening until late 2025. 2025 or 2024? Let's ask Mark Zandi. He's chief economist at Moody's. Now I'm getting confused, Mark. When do you think that's going to happen?
Yeah, no, did I say, was that a typo, 2025? No, I think 2024. By year end, this time next year, I expect fixed mortgage rates to be around 6%.
Okay, I mean, that's really not much, because I guess around 6% number is different than it being 6.99.
Indeed. I mean, if you kind of have a pulse on the market, every time mortgage rates rise north of 7, the market just goes ice cold. It's completely unaffordable. People stop transacting. Home sales just fall. Get around 6, it feels like life comes back into the market. And Kelly, longer run, abstracting from the vagaries of the ups and downs and everything else in the business cycle, I think people should get used to fixed mortgage rates somewhere 5.5%, 6%. So that's kind of where I think we should expect them long run.
The new normal?
Well, I guess going back to the future, maybe that's kind of sort of where we were. What was abnormal was the long period after the financial crisis when interest rates were just depressed. Now we're getting back to something that's more consistent with a healthy economy, and I think 10-year Treasury yield around 4, and that would put the 30-year fixed at 5.5 to 6, something like that.
Let me ask you something, and this is quickly turning into my chart obsession of the day. We're going to put up the 5-year inflation break-evens again. 208 is the reading there, and I'm looking back at the history throughout the 2010s when mortgage rates were incredibly low. 208 is kind of where we were for that period as well. So based on what the market's telling us, why shouldn't we expect rates to go back towards what prevailed last decade instead of staying at much higher levels?
Well, that gets to real yields, term premiums. I do think we're in a very different world. Lots of ways of thinking about it, but just think about it in the context of inflation. In the period after the financial crisis, the Fed was working really hard to get inflation up. Inflation was suboptimal. They kept their foot on the accelerator, and that kept interest rates generally low. Now, on the other side of the pandemic, feels like we're in a different world with regard to inflation. We're deglobalizing. We've got transition costs around green energy. So it feels like inflation is going to be more of a headwind than a tailwind. Fed's going to have its foot more on the brake than the accelerator. And therefore, we get more normalized, pre-financial crisis kind of interest rates.
Is the biggest risk, and not to put your equity analyst hat on here, but it's incredible to see how the home builders have been going to new highs constantly here, even as the housing market in general is completely frozen. It's like the flip side of the story. If we get a normalization in housing, is that the biggest headwind for the home builders? Anything that releases inventory back on the market, gets things back to normal, does that ironically hurt the hottest segment of that market right now?
Not for a while. I think they've got a nice demographic tailwind. They've got a couple things going. One is there's a very severe shortage of homes, particularly at lower price points, affordable housing. By my calculation, we're short by about 1.7 million housing units. That's a lot of units. That's more than 1 year's worth of production in a typical year. And they've got to make that up. And then I do think there's, underlying demographic demand. Here's the other thing, Kelly. Immigration is strong. I think we're getting this, the data coming in suggests that there's a lot more immigrants coming into the country than has been the case historically. And of course, more people, more households, more housing. So I think, for the next 3, 4, 5, 6 years, I think the home builders have some really significant tailwinds that could help to support them.
Although I don't always think of that kind of immigration as driving household formation so much as maybe literally being part of the renting population or something like that.
Well, it's yes, that's true. But it's adding to the demand for the housing stock and therefore, lifts all boats, I think. But you're right.
No, and obviously anyone it displaces as a renter, maybe they move into the housing pool and so on. So going back to the Fed today, what do you expect to hear from Chair Powell?
Not much. I think the Fed has the economy right where they want it. Feels like the job market's cooling in a very graceful, orderly way. Wage growth is moderating and pretty close to being consistent with their long-run inflation target. Inflation's coming in. It's still too high. But all the trend lines look really good there, and the forecasts seem pretty clear that we're going to get back to target sometime this time next year. Financial conditions, we can debate that a little bit, but stock prices, bond yields, value of the dollar, credit spreads, underwriting standards all feel like in a pretty good spot. So Chair Powell must feel pretty good about this. So I think his goal here is not to rock any boats, just say we're on track, and it feels like everything's moving in the right direction.
Right, although that said, I guess the million-dollar question for you is, do you think that they should avoid further tightening? Do they have to cut rates, pretty soon here the way inflation's going?
I don't think so. I certainly not raise rates. I don't see any reason why you would do that in the context of everything I just said. But the question is, at what point do you start to lower rates? And I think they've got some time. I think they're going to wait until they see that Zandy's forecast about inflation coming to target is right. And that probably won't be until next late spring, summer. And once they come to that conclusion, then I think they'll start to lower rates. Here's the other thing. It's an election year, right? And I suspect all else being equal, they'd rather prefer not to move rates in any direction. Once they do that, then they risk getting politicized and getting wrapped up in what's going to be a pretty, I think, uncomfortable election process. So I think they would err on the side instead of doing nothing.
One of the Fed's most recognizable
all else being
functions
equal.
is conducting
It
U.S.
is an election
monetary
year
policy,
on top of everything else.
which involves
Mark, thank you.
influencing
We'll check
interest
back in
rates
soon. We
and the
appreciate it.
availability
Mark
of money and
that
credit
drop in
in our
mortgage rates we
economy.
mentioned is boosting the
Congress
home
has
builders.
tasked
The home construction
with
ETF, the
implementing monetary
ITD, touching
policies
another all-time
that
high
promote
today, and it's up
maximum employment
54%
and
since
stable
January 1st.
prices.
Pulte,
High
DR
levels
Horton
of
among the
employment
components
provide
hitting
people
all-time
with more
highs, and those
economic
names are still trading at just
and
about
stable
9 and 10
prices
times forward
promote
earnings.
growth
by
Same with
making it
Lennar. They
easier
report
for
tomorrow after the
households
bell,
and
also around
businesses to
9 and a
plan
half
for the
times.
future.
We'll be listening for their
Monetary
updates on
policy
rates and
decisions at
incentives.
the
Looking
Fed
forward
are
to
made
that.
by the Federal
Coming up, the
Open
top
Market
internet
Committee,
trades for
which includes
2024.
all 7
JP
members
Morgan's
of the Board of
list is out.
Governors
Amazon
and
is number
presidents from the
1,
Reserve
but some of their other calls are a little more interesting. Like this one, already up 150% this year. We will reveal it
In
next.
addition
You can
to
tweet me your
conducting
guesses
monetary
at Kelly
policy,
CNBC.
the Federal
We'll
Reserve
ask the
also
analyst
helps
why
to
he still
supervise
sees
and
more upside,
regulate
about
the nation's
20% more
banks
upside this
and
year.
works to
We're back
promote a
after this.
stable
Dow's up 7.
financial system for consumers, communities, and businesses.
The Fed also works with communities, nonprofit organizations, and others across the nation to address housing problems, promote equal access to credit, and advance economic and community development.
The Fed also promotes stability in the financial system, because instability in the financial system can pose a severe threat to the broader economy and communities across the nation.
The Fed also...
Sorry about that. I didn't know that was playing in the background. Okay, so I'm back with you here right now. I do have one question if anyone is listening right now. I couldn't find a link to the presser at 2:30 or even the rate decision at 2 p.m. Now, I will have at 2 p.m. the news release in my hands. You'll hear from the news squawk someone highlighting the key points of the press release for the rate decision at 2 p.m. And I will continue to look for a presser link for the live coverage of when Jerome speaks at 2:30 p.m. But from this, where I'm at right now, I'm on the Fed Reserve YouTube channel. Can't find it. Can't find it on the Fed Reserve website either. So what else do I got for you? Let me see here. I'm going to read off a prepper or a primer for the rate decision here. And I'm just going to read this too as we lead into the 2 p.m. hour once we get that decision. Let's see if I can take this off. Where is the break time thing right there? Yeah, I'm on the Reserve's website. I don't see it anywhere. I'm on the website and I'm on the YouTube channel. I'm not seeing a link. If anybody sees a link to the actual anyone has a link to the actual hold on a second, I return that back. Slide that over. If anyone has a link to the presser, let me know. I don't see one out there anywhere available. Give me one quick second. I got to take this call. All right, back with you here again. I apologize for that. We're making some progress here on the website, and I had to take a call. I didn't have a choice there. Yeah, I've got the live link now. I apologize. I meant to say something. Harushi provided a link while I was on that call, so I do have a link. It's open, and I will turn it on as soon as we get to the 2 o'clock hour. So there's a few things here. Number one, at 2 p.m., you are going to get the live stream from the Fed, 2:30, whatever that is. You'll also hear a news squawker talking in the background, and what they're going to do is furiously review the PDF that's dropped with the rate decision, and they will highlight either hawkish or dovish points from that news release. So you have the initial reaction at 2 p.m., and then at 2:30 p.m., just be aware that whatever moves we make, you could see potentially a pullback from that move, awaiting Jerome Powell. Inside of these news conferences, there's a lot to be seen, right? You want to see what he looks like, how he's dressed. You want to see his demeanor. You want to see if he looks like he's in control. Sometimes he looks like he's in control. Sometimes he doesn't look like he's in control. And then another key point here is his reaction to questions from the press. Are they throwing softballs at him? Are they not? Is he getting angry? He's sometimes in pressers, he will get angry with lines of questioning. Other times he gets triggered. I've seen him in pressers where he starts out awesome sauce, and then like one of the right bench reporters will start to ask more poignant questions towards the end of his pressers. And sometimes they could, if they do it the right way, they can trigger him into like happy hawkish mode. Other times, he'll go against those lines of questioning. So it's important for you, if you can, oftentimes to pay attention to the presser right to the bitter end. Last rate decision, I think they went all the way to 4 p.m. That's very unusual. Right to 4 p.m. Market was just murdered into the close. So pay attention to the length of time that presser takes place. And to be honest, if I had to guess today, like best guess, trader hat on, 0 rate increase, data dependent, and then I don't know if it's hawkish, but a promise of more rate cuts to come, or excuse me, rate increases to come, the threat of more rate increases to come. I think this is likely a non-event. I think you're going to see a large part of the market be hedged here, and we get the crush on that. I also think that to the upside, that same thing. People that are looking for that all-time highs, probably not. It would be fascinating to see if we could get that new high above, which is right here. Even if we tag it briefly, this is the January 22 high of 467.13. I'd really like to just see it. We are here. Okay, so even if it's brief, we go up and touch it and just break above it, even if it's just the tip, would be nice to see. So if you're a bull, that's what you're looking for. That's the anticipation. We are here. Okay, so there's no reason not to at least touch it up there. Now, saying that, if we do that, I think there's a pullback. I don't today, at least, some kind of vol crush. If I was a bull, we'll trade it. If we break above it and keep moving higher after this rate decision, we'll trade it. But just be aware, if you're a bull, that oftentimes these things are used to trigger your FOMO, and then they trap you. So just be aware of that later today. Now, there are some things that likely aren't priced in. Of course, 25 BPS is not priced in. Also, that thing I talked about earlier, if he doesn't raise, but he threatens and says to you, we're going to have another meeting in January, that's not priced in as well. And then there's some other things that aren't priced in. Would be if you get the no rate hike and then you get a victory lap or a bullish or a dovish Jerome Powell. That's not priced in to today. So some key points that you're going to be looking for today is he dovish? Not priced in, right? Not priced in the market. Another thing would be not priced in would be if he not only threatens, but says we've got another decision coming up in January. I'll see you in a month. says something like that, that's scary, right? That's not priced in. Another thing that's not priced in is 25 BPS. If he does a surprise hike today, it's going to be initially probably bearish off of that. So just be aware of those things. Now, if we get a non-event, I would expect them to crush the up and down side at some point today. And we should stay on our trend. All things being equal, stay on trend. Let me know in the chat what you think. How about this in the chat if you'd like to give your thoughts in a brief, like 0% hawk, 0% dove, 25 BPS, not your feelings or what you want. Say, or you can even say trader hat, Main Street hat, trader hat 0.025 or rate cuts or whatever it is. Rate cuts, as a matter of fact, if we actually got a cut today, which I don't think that we do, it's a very small possibility, like small. But if it was, my take would be that we would scream to the upside for liquidity, and then they would sell the fuck out of this market in a bad way, really bad way. But feel free in the chat today to comment however you want to comment. Whatever you want to say, do your thing. Yeah, so Kid Time is saying non-event. Last three have been kind of non-events, haven't they? Then we have made moves down and up in prior events, but they've been non-events. All these last like 3 rate decisions, I think, were generally non-events. They weren't like the kind of events where fucking whole market blasts down to the depths of hell. Well, they do afterwards, but not the event. So where do we go, Cap? 466 at 2 p.m. Good question. So if you want what I think happens here, I'll give it to you right now. What I think. Let me see if I can snap some lines in there. That's a good question. You want my take on what I think happens? Do not trade this, okay? So there's 2 p.m. Be like, hey, Captain told me to do this, or Captain thought this and he was wrong. I don't want to hear any of that crap from you guys. You guys are, it's not you guys, but some of you are brutal. Some of you are like, some of you guys are fucking, some of you guys are like, I want you to tell us what's going to happen, and then if it doesn't happen, you're like, I'm pissed off at him, I don't like him. So what I think happens is you're going to get an initial move down right here. Likely it's just touch the tip, possibly even down here. And then I think you're going to get the move higher. So let's see if I make this a little bit thicker in a different color. 2. Yeah, there we go. And maybe change the color to white. I think you get your initial rip higher. And I think that you might possibly. Here, let me draw this better. Hold on a second. Hi, Kitty. How are you? We got new cats, by the way. I think you get that weakness. You get that initial push up to R1. You slam it back down, and then boom, right there. And then I think you come back down for the meeting. You're going to be all bulled up. We're going to come right back down into this meeting. Hold on here. 463. Right down there, and that's how we close. Something just like that. That's what I think we're going to do. Okay, so you get your squeeze up if it's a non-event. Come down here, right, 2 o'clock. Boom. You get fucked on your calls. They reprice. Boom, you got to get back in. Calls print. You fail the high back over here, or you possibly touch it. Whoop, right above. Come back down for this presser. And then then they pin it, and then eventually we come back down and bleed off into the close. That 465.0 and the or excuse me, 4650, and the 4600 is possibly in play for today. So let me move all this over here. Hi, Kitty. I love you too, Kitty. Move that over there for you. I like you too, Kitty. You want to get frisky and have nap time? I understand. Leave that over there. January 2022 high right there. R2 right here. R3 right here. So something like that is the expectation. Something like that. Does that work for you guys? Are you guys anti this? I think this is your risk into the event down here. Gonna run this bad boy up, run it up there, and then we're gonna come back down. That's my thought process here. I'm gonna delete all this now, okay? So it's not in your way. I'm gonna delete that right there. We've got 20 minutes until the rate decision. Well, I think there's a better move for bulls and bears on the 15th. Or maybe not bears. I think for bulls, their best trade is likely on the 15th. Now, I'm going to say something on this, okay? What I've noticed the past 4 weeks, is the timing is right, but there's some front running going on. There's a lot of front running happening, and retarded, like an engine, right? Like a retarded engine. There's like they're doing it a day before, a day after the expected moves, and so you're seeing like front running. I'm assuming this is retailers. I know a bunch of it is Daler Gamma and stuff like that, but I'm noticing that like the timing is slightly off this year, and I think it might just be we're gonna get ahead of you before you get in, kind of stuff. So it's possible it could happen before the 15th too. By like a day, which is fine. I can do the day. The day, like, does it happen today? Does it happen tomorrow? That kind of stuff. You'll cry laughing if they raise today. Dude, I hope that all right, I got to switch this shit. My Main Street hat, I'd really like to see a raise today, I'll be honest. Like, there's a side of me, a Main Street side of me. If I was a young person or an old person, if I was young or old, if I was 18 to 35, I'd be like, raise the fuck out of this shit. And if I was old, I'd be saying the same thing. If I was retired, like truly retired, like I got the Social Security, I got the 401k going, the pension going, and I would want that hike as well. I really would. You're going to see old people get priced out. They will. And they're going to get their rug pulled from underneath them, and then if they don't continue to raise rates, if not now, in the future, and you're going to see a door closed to young people. Well, that's truth. That is truth. So that's my take on that. I see you, Demente. Yeah, I don't know. I mean, we're poised for all the good stuff, right? Market seems like it's poised for all the good stuff. I can tell you this, that we can tell you this for a fact. This came off a terminal, and I think I read that to you earlier. That I thought maybe I did or didn't read it to you. I'll read it to you again. So I do want you to know that. Let me see if I can read this to you here. So yesterday's performance, right? It's impressive, but major buyers are absent. I want you to know that the major buyers, like the CTAs, they weren't buyers yesterday. They're likely not buyers today. They're just sitting on the sidelines. Doesn't mean they're sellers, net sellers. They're just not buyers. Dealers are not buyers. Corporates, they're fading buyers right now. So it's the market's just kind of like waiting. There's a lot of people out there that are waiting for this decision. I just got the phone with Joe Donut, and he's like, "We're waiting. We're waiting to see what he has to say." So I'm going to assume here
At
that
2 p.m.
most
Eastern
people are
Time, we
waiting
get
as
the
well.
US interest rate decision. Forecast no change on the prior 5.5%. The FOMC summary of economic projections, and the FOMC rate statement. Looking at some analyst views ahead of this, Wells Fargo say it appears that the Federal Reserve's tightening cycle has come to an end. Since the summer, the FOMC has been keeping its options open regarding the possibility of an additional rate hike. However, recent economic data and comments suggest less need and desire to exercise that option. We see the committee leaving the Fed funds target range at its current level of 5.25 to 5.5% at the conclusion of its upcoming meeting on December 13th. If realized, the third consecutive hold would suggest that rather than the FOMC merely hiking at a slower pace, the Fed funds rate probably has reached its terminal level of this cycle. With the committee seeming to settle into a prolonged hold, the conversation around the future policy path will shift toward when and under what circumstances the FOMC eventually cuts rates. We have maintained since the FOMC last raised the Fed funds rate at its July 26th meeting that the increase was likely the last of its hiking cycle, a view not always shared by market participants. As recently as October, market pricing suggested that another 25 basis points hike was slightly more likely than not, a bet bolstered in part by committee members' own projections in September, as shown in the near.
But we just got cut off here.
The declining odds of one additional hike this year comes as both sides of the Fed's mandate are moving toward their longer-run desired levels. Notably, inflation has made encouraging progress towards returning to the FOMC's 2% target. In October, core PC inflation, the Fed's preferred benchmark for price growth, fell to 3.5% year over year, nearly 2.5-year low. The latest monthly reading suggests the recent pace has downshifted even further, with core prices in October up at a 3-month annualized rate of only 2.4% relative to July.
Dude, look at that rug down there. Woof. There's a little tiny rug down there. Not much sitting right here, is there? Not a whole lot of support right there. Not a lot of support right there. Sorry, I apologize for the coughing. I'm losing my voice. My voice is getting destroyed here on streaming every day. What's my position into this? I have I've got a putback spread on the market that expires in June. I still have not harvested the long side of that trade. Looking for that tag of all-time highs to cut that side of the trade out. The other side of the trade I'll leave on into, hopefully I can get a downside move in February or April and close the other side of that trade. If not today, if something bad happens, let me see here. Let me read off what I've got to you, how I'm positioned right now. I've got expiring today 469 Cs. Expiring today 467 Cs. Expiring today a fuck ton of 450 Ps. Like bloodbath Ps, like fuck ton of them. Very cheap, cost me nothing, like a penny or something like that. I've got what else do I have? I got a bunch of puts for tomorrow, for the 15th, 2 days from now. I've got 450Ps, a bunch of those too. So I got shit all over the place. Whole bunch of crap just sitting in my brokerage. And if we start making these swings, I'm gonna try to close them out one by one. And that's where I'm at in the market right now. I got you figure if you own the market in any way, shape, or form, you got a bunch of penny fucking
Eastern
puts in
time,
case
get
some
the
doom
US
comes.
interest rate decision forecast no change on the prior 5.5%.
I'm going to turn this up for a minute. Bear
the
with me here.
FOMC summary of economic projections and the FOMC rate statement. Looking at more analyst views, ING say the Federal Reserve is widely expected to leave the Fed funds target range at 5.25 to 5.5% at the upcoming
You're watching
FOMC
liquidity
meeting.
leave the market right now
Softer activity
on
numbers,
Bookmap.
cooling
You can
labor
actually see,
data,
you'll see your
and
screen
benign
over here
month-on-month
will start
inflation
to
prints
blacken and
signal
stuff,
that monetary
dark blues,
policy
dark
is
blacks, all that
probably
kind of stuff.
restrictive enough
Just
to bring
watching
inflation
the markets
sustainably
wait
down to
for
2% in the coming months.
Decision.
A narrative that is being more vocally supported by key Federal Reserve officials. Today, markets are clearly of the view that interest rates have peaked with 125 basis points of rate cuts priced through next year. Underscoring this shift in sentiment, we have seen the US 10-year Treasury yield fall from just shy of 5% in late October to a low of 4.1% on December 6th. In that regard, the steep fall in Treasury yields in recent weeks is an easing of financial conditions.
All right, I've got the Fed.
For example, mortgage
230.
rates have been swift to respond, with the 30-year fixed-rate mortgage dropping from a high of 7.9% in late October to 7.17% as of last week. We think the Fed will eventually shift to a more dovish stance, but this may not come until late in the first quarter of 2024. The US economy continues to perform well for now, and the jobs market remains tight, but there is growing evidence that the Federal Reserve's interest rate increases and the associated tightening of credit conditions are starting to have the desired effect. And from BlackRock, they say we see the central banks pushing back against market hopes for rate cuts at this week's meeting. We expect structurally higher interest rates in the new regime.
I've got green puts and green calls right now. Both are green right now. There's some put premium out there. Some people are creeping in right now. Loading up on puts right now this last 10 minutes. You can see the premium kick on my puts.
Do you want to stay up to date?
I'm surprised. It's like last second just slam the put buy button to hedge yourself.
Then sign up today and get our special offer of Financial Juice Pro for a year's worth of our service.
Cheap way to hedge your underlying, I guess.
92%.
It's retailers. I'm like, no, it's not. It's not fucking retailers. I've got a chart coming for you guys. Joe Donut's going to give us a chart showing the zero-date market and the wash of retailers from the zero-date market after COVID, and how that market has actually been taken over by banks, not retailers. Well, it looks like it wants to squeeze, doesn't it? Look at those hammer candles right there. Market wants to explode. All I want to do is like clear out some calls or puts and leave the other side, and whatever happens there, start cleaning out the the trunk of my car. Look at Sammy. He's getting all spicy in the chat. Sammy's like on fire in the chat right now. Yeah, all my stuff is expired. These are all zero dates. I got one for tomorrow, but that's only these are like crash stuff. And even the tomorrow, I think they're for the 15th. Even the crash stuff, I would expect the close to close those out on the close. But we could get a ramp in premium and IV, even if you'd expect a repricing. We can flip to like this negativity, and so if everybody's positive right now, we got the IV crush. You can actually get an IV kick on the open tomorrow if we're gonna blast to the up or down or continue blasting. Normally, I'll still see the repricing on the call side, especially it's lopsided like that. But on the put side, I've definitely seen a continuation, even with IV crush. So I might stay in those for another couple days if we did get something nasty. You're going to hear these guys talk about the rate decision here. Okay, in the next 6 minutes, you'll hear us news squawker talking.
At 2 p.m. Eastern Time, we get the U.S. interest rate decision. Forecast no change on the prior 5.5%.
I want to let you know that when that guy starts talking, I'm also going to receive the actual press release. I will be in the background reading it and seeing if anything is missed. Okay, so if anything's missed while you hear that guy talking, I'll pop in and let you know if there's anything material that we don't know. I doubt it, but if there is, I will let you know. Excuse me. We drink some water here. If you're just joining us for the first time, if you want to join our Discord, you can. I'll leave a link to the Discord in our chat. If you could do me a solid here, this is free what we do. If you could go on to your favorite social media and try to repost. I have it pinned to my profile on Twitter. If you could repost links to these streams and try to get other people to watch them, I'd appreciate it. It's a free way to support the stream and what we do here. So if you could do that, I would really appreciate it before this news drops. And I'll get you guys some invitations. Hold on here. Also, follow at Captain's Alpha. We provide free daily levels. A lot of people pay for that stuff. We provide them for free. All you do is follow at Captain's Alpha. And every morning you get your levels from us. We are expanding that in the future as well to include the entire stock market. And let me see. Copy that. Close that. If you're a new trader, if you're a losing trader, we have people that hold on, let's put this in here. We have people that will make you a winning trader, believe it or not, inside of our Discord. And they are mentors. We also provide, or they are the people that take on these mentorships, show proof of turning their trading around. So if you're a losing trader, I don't care how many years you have in this market, but if you're fucking losing, get inside this Discord because we can turn your career around, make you a winning trader with our mentorship programs. We are also launching a website this week on Friday. Well, we hope to launch on Friday to keep what we do sustainable. If any of you know us because of what we do is free, that will always be maintained in the future. Outside of maintaining the safety and security of our Discord people and our membership, you should see no change. If anything, you should see an enhanced free experience with us. So if you've always expected free from us, you should see some kind of enhancement to your experience with us in the future. And so stick around, see what's going on with that with us. Find me on Twitter, too. I'll follow you on Twitter. I'll come back. I don't care if you got 1 follower, 5 followers. I will follow you if you are a market participant and you post specifically about the markets. I will follow you. I will not follow you if you're doing all kinds of other whack shit. I don't care if it's like crazy left, crazy right. I'm on Twitter for the FinTwit and the shit posting. That's why I'm there. Shit posting and FinTwit. I'm not there for anything else, believe it or not. I did make a Threads thing. I'm on Threads right now, I believe, and I'm on I think it's whatever the one that what's his face from Twitter built. So I do have some other social media presence. I've been going back to Wall Street Bets recently too. Wall Street Bets is going back to its roots. If you haven't been on Wall Street Bets in some time, try to go back there and help those kids out. If you're an older trader that came from Wall Street
1 minute
Bets,
remaining.
That was really fucking loud. He'll say no raise, or he'll say 25 BPS. He will say it right away.
Ten seconds. No change, no change. Rate remains unchanged at 5.5% as expected. So FOMC median forecast shows rates at 3.6% in 2025 and 2.9% in 2026. Median 2024 unemployment projection unchanged at 4.1%. FOMC median 2024 growth projection at 1.4% versus the prior 1.5%. FOMC rate forecasts show a wide range of projections for 2024.
Sorry, I'm taking profit
Economic
right here.
growth
Heads
has
up on the
slowed
call
from strong
side.
pace in the third quarter.
Taking profit on the first one right here. Just be careful. If they reprice in here, you could get the second.
So the Fed will
upside to
continue bond
R2.
holding reductions as previously planned, and the Fed will continue the same pace of reducing treasuries. Tighter financial credit conditions are to weigh on the economy. The FOMC vote was unanimous. The Fed repeats US banking system is sound and resilient, and inflation eased over the past year but remains elevated. Median forecast shows 75 basis points of rate cuts in 2024 to 4.6%. Fed will assess
that's good.
the extent of any additional firming needed. The FOMC median 2024 PCE core PCE forecast declined to 2.4%. Fed officials' median view of Fed funds rate at the end of 2026, 2.9%.
right here,
Fed
real quick.
officials' median view of Fed funds rate at the end of 2025, 3.6%. The median view of Fed funds rate at the end of 2024, 4.6%. And the median view of Fed funds rate at the end of 2025, 3.6%.
As we come into it, I'm going to take some profit again. I'm on some calls right now.
Median view of Fed funds rate in the longer run, 2.5%. Fed projections show 8 of 19 officials see policy rates above 2024 median, 5 see it below that. And Fed policymakers see weaker GDP growth and the same unemployment rate in 2024 compared with September projections. Fed officials see inflation at 2.4% in 2024, returning to the 2% target in 2026.
Oh, we're so close to that high, dude. Tag the high. Tag the fucking high. Slam into 467.13, please. You're fucking
And inflation
right there.
has
Do
eased but remains the elevated, and FOMC strongly committed to returning inflation to the 2% target.
Tag it.
And job gains have moderated but remain strong, and unemployment rate remains low. Tighter financial and credit conditions are likely to weigh on economic activity and hiring and inflation, but the extent of effects remain uncertain.
After this squeeze, remember at 2:30 we have a press conference.
The S&P 500 gains ground after the FOMC statement, last up at 0.3%. US Treasury 2-year yields fall further after the Fed statement, last down 17.5 basis points at 4.558%.
Ooh.
Fed swaps price 130 basis points of cuts for 2024 versus 115 basis points pre-Fed decision.
Just the tip. Just give me the tip. Oh. Whoa! Whoa! Just give me the tip!
Euro rises to 1.084, the highest since December 5th. Yen gains 144.2, strongest since December 8th.
There we go. There we go. All right, I just got out. We just need the tip. We just need the tip. It's right here. Yeah, right there. We just need the tip. Just give me the tip. Just give me the tip. Just give me the tip. Pull it back all you want for Jerome Powell. Just give me the tip right up here. Just give me the
S&P 500 continuing its advance after the FOMC decision, up 0.56%.
Get your tweets out there, boys and girls. We're close. They're edging us.
US interest rate futures raise odds of a May rate cut to 90% after the Fed decision versus 80% just before.
Just one more tick, 2 ticks. Oh, it's like a tick. It's like a penny underneath. Just one more. Oh, and we got R3 to the upside too. 268.97. I'm flat right now on calls. Still have puts on right now, hoping that we reverse to the downside. I'm flat right now. I've been adding and taking calls off. I'm flat right now at this point. Your R3 upside target, 468.97. If you're still long here, you're going to let some runners go on for more upside movement. 468.97. I still have puts on. I'm hoping for a pullback to the downside so I can close puts out. Look at that right there. Woo! I'll leave that up. That R3 is still up here for you that want to watch it. If you think we're going to continue higher, don't get caught in repricing. Yeah, if you're a call buyer, take your money and run. Even if we squeeze up here, take some money off the table. You quick points here for you. If you're trading zero dates, right? You buy for 25 cents, you're selling for 50, 75 a dollar. Go back in and buy 25 centers again. Don't be like, yeah, I'm gonna stay long and they're fat at $1.50. Just get out, buy them cheaper, run it up, and then get out again. Keep the money that you're making on this. I wonder if that's this one right here, by the way. And we still haven't broken through. We still haven't broken above that high.
U.S. rate futures priced in more than 100 basis points of rate cuts in 2024 following the Fed decision. Little changed from before.
All right, so I'm gonna take a little taste here. Hold on. I shouldn't be doing this. I bought a bunch of cheap-ass calls. I think we get rolled here, but we'll leave them on and see what happens. Just in case we get this little tip break right here. I mean, they might try to save this for Jerome, but for his victory speech and his... I don't think we've actually ticked the SPY new high. We might have ticked it on SPX. I haven't checked SPX yet. Yeah, you want to short the fuck out of this, don't you? Jill Natola. I'm the same way, man, Jill. I really am waiting for that. I really am waiting for that moment, man, where it just rolls hard and heavy to the downside, Jill. Just like max fucking short. Just ram it for like 3 straight days. Let's see if we can get this tag above here. I am back in some calls again. Zero dates. I'm in 469 Cs if you want to know. 469 Cs. It's right up here. And if we can just tag this and break through and get a new high, I'll cut them loose. Don't follow me on that trade. You get rolled. Make sure that you've been making money throughout the day and you've been taking some money off the table. There's no reason for you to be a loser at this point. Oh, creep on up there.
US rate
Creep on up
futures
there.
lift March 2024 rate cut chances to more than 60% following the Fed's statement, according to FedWatch data.
Ooh. You see it? It happened. That was there right there. You got it. That tick right there. It looks like it just broke above. At least the SPY January 22 high on a daily chart. Looks like we got just the tip just then. Sorry,
According to the
Alexa's-
EU budget commissioner, Germany's 2024 budget deal is a good sign.
Look at that
Changes
reach for the
dynamics and
sky.
talks on EU budget revision.
Hold on here. I got to do this quickly. Looks like there's some sellers up there. Be careful. You see it on Bookmap right here? Look at them. Look at that supply right there. Need to break through that supply. If you look at that Bookmap up top, we're just grinding through those sellers up there. Need to smash through those sellers. See how they're parked right there in that white bar on Bookmap. Be really careful here if we roll to the downside. We got literally one pin. Look at that one pin right there. Look at how small that thing is right there. That one little break above right there.
We have posted the FOMC press conference live video on the feed for all those interested.
All right, hold on here. We're going to switch over to the... I should watch this more closely. Hold on a second here. All right, still nothing from the Fed. It's 2:12, 2:30. Be careful. At 2:30, we have Jerome Powell speaking. So at some point here, you should see a roll. Time will be against you if you're a bull at some point into that presser. Looks like repricing's happening right now. I'm watching repricing inside of the option chain. Be aware of that as well.
US stocks extend gains. S&P 500 last up 0.6%.
See if I can read anything here on FinTwit. What people are saying, if I see anything. U.S. Fed rate futures raise odds of March 2024 rate cut to more than 60%. Wow. U.S. interest rate futures raise odds of May cut to 90%. Whew. After a Fed decision versus 80% just before. What else we got here? We've got, man. Oh, yeah, dude, Jedi Marcus picked up on that. Good job, Jedi Marcus out there. If you were out there, I love you, man, for what you do. What else we got here? Annie Constant, the Fed has arrived on Soft Landing Island. Just posted that. The Hooligan said Fed or IV crush in 3 minutes. Looks like Foot's making a victory lap. ST short seller not seeing anything. Red Pill Finance not seeing. Pelk not seeing anything right now. Just checking on these guys out there, seeing what they're talking about. Let me go to my Twitter and see what's on my feed here. See what's bouncing through my feed. See if I can read anything important. I guess Jerome Powell is hell-bent on becoming Arthur Burns instead of Paul Volcker. Dow Jones Industrial Average on track to close at record high. What else we got here? We only have 100 more NQ points for this March 24 contract to trade above all-time highs in NQ futures. Wow. This is from Parker Ross. FOMC statement much more dovish than expected, with dots also moving much lower. U.S. 10-year plunging in response. That's Parker Ross on FinTwit right now. What else we got here? Didn't go through. Burr, baby, burr, baby, burr. What else do we have here? Let me see if I can read through and find anything. The Fed has arrived on Soft Landing Island. Repost that for Andy Constant. I got Nick Timmeros in here 15 minutes ago. FOMC holds rates steady and retains a weak tightening bias. In the statement, FOMC median projections of 3 rate cuts for 2024. That's Nick Timmeros. We'll repost that for him.
U.S. Treasury 10-year yields fall to the lowest since August, last down 12.5 basis points at 4.08%.
What else we got going on here? Most Fed officials see rate cuts in 2024, too. That's huge. That is huge. Most Fed officials see rate cuts in 2024. That's coming in from Walter Bloomberg this afternoon. What else do we have here? I think that's it right there. That's all I can see. We're just grinding down the options chain right now. Just the options chain, even with this push being ground down currently, where we are. Do not get caught on a roll down into Jerome Powell. Let me ask you guys a question on the stream. Do you think that Jerome does a victory lap? We talked about we are priced in for a hawkish Jerome Powell. From everything we've seen since this morning, from Janet Yellen to Nick Timmeros to a lot of these people that claim that they're professionals out there, reading some of these.
U.S. Treasury 2-year dropped to the lowest since mid-June, last down 19.6 basis points at 4.537%, and the yen gains more than 1% to 143.92 per dollar as U.S. yields fall.
Do we get instead of the hawkish expectation, do we get victory lap Jerome Powell? We're going to find out in 13 minutes. From everything this morning, everything into this afternoon, and that release, I think you might get you might possibly get victory lap Jerome Powell. That would be a shocker, wouldn't it? That is not priced in. We priced in a hawkish Jerome Powell at 230. He's not, or everyone
the
else
S&P
is saying,
500 still extending gains after the FOMC signals the end of rate hikes and lower rates in 2024. The index is last up at 0.65%.
I love it. Coming out like Bill Belichick. I love it. Would victory lap moon the market? It's possible. It's possible. Even if it's only brief. Just panic, right? What you don't want to do is be short the market and see him get exuberant. And even if it's only brief, right? And you get like a FOMO buy into the market, dealer's chase, and that's it. We're screaming up. So be careful. It's possible. It's possible that I'd say the odds have improved of a less hawkish stance in this presser and a more victory lapish stance. I don't think it's guaranteed, but if we were at like a 30% chance of a victory lap, we're probably at a 40 to 60% chance of a victory lap speech. So be very careful as we head into this presser. Just from what was written, I can read some of this to you right now. I'm reading it in the background, but if you want to read some of this to you, I can. But from some of the stuff that is inside the press release, even the press release is looking like a victory lap. So I'll read some of this to you right now. How about that? Okay. so you can read, or you can make a decision for yourself. Starting to just push higher
At 2:30
now, okay?
p.m. Eastern Time, we get the FOMC press conference. We have posted.
I'm going to read some of this to you. The Fed, we will continue to hold bond holding reductions as previously planned. Fed will continue same pace of reducing Treasury and MBS holdings. Tighter financial credit conditions to weigh on the economy down the road, right? Not today, but down the road. That's implying that we are going to cut rates in 2024. We are squeezing. Now, if you're still long with me to the upside, if you bought more calls, congratulations right now. Woo-hoo-hoo-hoo. This in the FOMC statement. Median 2024 employment projection unchanged at 4.1%. They're saying no. Well, the median means we could still hit that 6 or 8%, which would force the Fed to cut rates. Beginning to squeeze now, looking for that 468.97. If you're following those 469 C's, burr, baby, fucking burr out there. Sorry. Hold on 1 second here. The FOMC vote was unanimous. Unanimous. Economic growth has slowed from strong pace in Q3. Rate forecasts show wide range of projections for 2024. Median 2024 growth projection at 1.4% versus 1.5%. Inflation eased over the past year, but remains elevated. We will assess any extent of any additional firming needed. That is a change in posture, change in verbiage. I'm going to read it to you again. We will assess extent of any additional firming needed. That is a more dovish statement from the Fed at this point. Median 2024 PCE and core PCE forecasts decline at 2.4%. Median view of Fed funds rate at end of 2026, 2.9%. Previous, 2.9%. Officials' median view of Fed funds rate at end of 2025, 3.6%. The previous was 3.9%. Starting to reach for the sky right now on SPOOs. Fed swap price, 130 BPS cuts for 2024 versus 115 BPS, or BP, excuse me, pre-Fed decision. Median view of Fed funds rate in longer run, 2.5%. Previous was 2.5%. No policymaker sees the end 2024 policy rate above the current level. Read this. Let me read this to you again. No policymaker sees the end of 2024 median, policy rate above the current rate. Fed officials agreeing that we will not be this high by the end of 2024. Fed projections show 8 of 19 officials see policy rate above 2024 median. 5 see it below that. That's a change. Fed policymakers see weaker GDP growth and the same unemployment rate in 2024 compared with the September projections. This is all bullshit, by the way. Fed officials see inflation at 2.4% in 2024, returning to 2% target in 2026. So bumpy road. So 2.4 next year, and then a bumpy road into 2026 with finally reaching that 2.2% target. U.S. Rate futures price in more than 100 BPS of rate cuts in 2024 following Fed decision. U.S. rate futures lift 24 rate cut chances to more than 60%. I think the May is now at 90%, and the March is at 60% for cuts to begin. This is going to, we have to talk about, we got 6 minutes left. We're going to have to talk about the front running of those cuts, the ramping of we could see an acceleration here in the market, some big moves in the market coming up due to some of these statements here. Now, we're going to wait for Jerome to make a statement, but this press release, this official stuff, Stuff's gonna move fast, I think. So let's see what happens in the future. We'll wait right now for Jerome Powell to come out and wear his red tie, his purple tie, or his green tie, I guess, or blue tie. You want to take your winnings here, you're more than welcome to. Remember, time's against your side. You want to take your money and run. If you want to stay long on anticipating Jerome Powell, you got R3 to the upside. Remember that there is going to be some weakness right now coming in to this presser. You got 5 minutes left. If you want to cut your longs, cut your longs. He's coming out and look at the market here, just hanging dong up here. Woo! Valhalla, baby. We did Valhalla. Congratulations, Bulls. I'm going to check SPX really quick. Give me one quick second here. I want to check the SPX Gamma picture. Let's take a peek at Gamma and see what it's saying. We still got room up here to run. You see that Gamma bar up there? SPX 4,700. 4,700 on SPX is the major resistance to the upside here. So 4,700 on SPX. So keep that in mind, okay? That we can continue to the upside. 4,700 on SPX. Mark that on your charts at home. Powell might come in a green suit today. You guys are terrible. Just like full green. Oh, forget the suit. Just like, what's the green full suit with the zipper on it? It's just not, it does like the gimp suit, but it's just full green. So you guys are saying JPM is so bagged, LMO. We say big moves meeting up only. Does the collar act like a magnet still? It still does. Collar still acts as a magnet into end of year. You should be asking these questions after the event today. Like tomorrow, ask those questions. But yes, still a magnet. Still a magnet. Still a magnet. I'm still taking that trade. One way or another, I'm taking that trade without a doubt. I don't care what price is. I don't care price is up, price is down. Get into like that last 2 weeks, last week, and we're all bulled up or we're all bared up, and definitely taking that trade. Matter of fact, I'll always take that trade public. So you either see it here on the stream or you see it on Twitter. Never like I'll never come out afterwards and be like, oh yeah, I took that trade or whatever. You'll see me say it before. Hold on, what are they saying on? The people are saying stuff on Twitch about Jerome here. Hold on, I gotta read this. He might walk onto the stage with a top hat and take it off to reveal a dove sitting on his white hair. The VIX barely moving. What else we got here? VIX should VIX. Let me see what VIX is at right now. $12.17. Nope, no movement. No movement on VIX right now. What else are you guys? Let me read through some of this. Fuck your puts hat. Hey, as a matter of fact, let me play something. Or do we have time to play? We got 2 minutes left. I was gonna play. I gotta skip. No, yeah, snooze this. No ads. I don't want any ads. I gotta turn ads off on live stream here. Hold on a minute here. I'm gonna pause ads as we're coming into this rate decision presser with Jerome Powell. 2 minutes until he comes on live. I want to play Trader Podcast's Jerome Powell meme right now. We don't have enough time. I'll do it. I'll do it after the presser or towards the end of the presser. I'll put it on the screen for you, so you can check out Trader Podcast's meme from Jerome Powell. I should have played it. Should have played it like 10 minutes ago. Remember, 4,700 on SPX. 4,700 on SPX. We hit Valhalla, baby. That's all I wanted to see. But this is all I cared about. Like we took out the prior high and I've been waiting for this for how long now? How long has it been waiting for this? Was it January 7th maybe? Been a long time, right? If you're a bull out there, long fucking time. Yeah, I got a whole bunch of other stuff to talk to you guys about. This is closing the door. This is closing the door. So if you had a low in October, right? That 3,500 low in October of 2023, you're seeing happening right now in real time. If you remember back when we were making videos then, right? What did we say? Said it on Twitter, said it on video, said it everywhere, said it in private videos, said it in Discord. What did we say? We said, you should buy this, even if we return here. And you have a higher probability of never returning here. So you buy it. Okay? You don't want to miss it. And if you bought it, congratulations to you for doing that. Now, a second narrative came out. And the second narrative was, we're definitely going back to 3,500. I'll get my chance later. These are the sellers, right? I'll get my chance later. The door is being closed to now that statement. So they're closing the door to 3,500. You're now starting to see 3,600. If we explode to 4,800, you're going to close the door all the way up to 3,800 and 3,900. That's going to put us looking down towards 38 to 4,000. That sucks for a lot of people out there. There are people that made those statements, right? That wasn't the bottom will return in a negative light, not in a positive light. You should have bought 3,500. Right now, like start thinking about any kind of pullback we have or crash. What is that now? If we get up to 4,800, that's what? 25, 30% downside move. Possible? Slim. Slim probability. So doors closing on that statement. Doors closing on revisiting 3,500. Bottom looking like worst case scenario 3,600. And if we go higher, you're going to start seeing levels like 38, 39, and eventually 4,000. So if we ever go back down to 4,000, 3,800, you're going to look back at that 3,500 and say, I should have bought that fucking bottom. And if we ever have that again, right, slam back down to 38 or 4,000, you now know that when you go back there, that you should be buying those bottoms every time. Nope, sorry about that. Not on. Let me put this back on again. Yep, still nothing on. Still no Jerome. Still no Jerome. I don't see it here.
From the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. 469Cs. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably
that
toward our
red bar
goal.
down below is the 4,700
Longer-term inflation
gamma
expectations
bar.
appear to
So that
remain
red
well
bar that you
anchored,
see down there, if you're
as
looking for a
reflected
place
in a
to take
broad range
profit.
of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation.
Here.
The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so
trading
that's what we wrote
469,
down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Scratch that.
Mr. Chairman, the microphone, sorry.
Let's say
Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate.
Top of the market,
and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the
469 is
table.
now trading 91 cents
when
on
you
that
get to that
R3
question,
tag.
and that's your answer.
They were like 27
there's
cents a little bit ago.
Naturally, it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this. We are seeing strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature, and we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view.
With you, by the way.
And is clearly a topic of discussion out in the world, and also a discussion for us
now trading
at our meeting today.
469.569, just 4 more points left to go.
Nature of that discussion today. Thank you.
Sure. So it comes up in this way today.
Careful here, careful
Everybody
here.
wrote down an SEP forecast,
Catching your
so
stops
many
here. Be
people
very
mentioned
careful.
what
This might be the turn.
their rate forecast was, and there was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. And
close to that gamma
preliminary
bar,
kind of
real
discussion
close
like
to that gamma bar up there.
Not everybody did that, but many people did. And I would say there's a general expectation that this will be a
smash
topic
into
for
it,
us
baby.
looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Let's go to Rachel. Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for.
4 points left to go to slap 4,700.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt, since the beginning, that there was a possibility because of the unusual situation.
Just heads up here, too. My
the
puts
economy
for
could cool
Wednesday
off,
are holding just fine.
in a
They're
way
doing just fine
that
for Wednesday.
enabled
Zero dates for today
inflation
for puts.
to come down
They're at zero,
without
but they
the kind
cost
of
me
large
fucking
job
pennies.
losses
It
that
costs
have
me like
often
1,
been
2, 3, 4
associated with
pennies.
high inflation
I'm
and
not too
tightening
concerned with
cycles.
that. Making great money
So
on the
far,
call side for today.
that's what we're seeing. That's what many
Wednesday
forecasters
puts,
on and
though,
off the committee
just
are seeing.
down,
This result
down
is not
25%,
guaranteed.
down
It is,
30% right now.
uh,
That's it.
far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
One more push higher here.
I'm
See if we can
curious if
slap
you're
that
looking
fucking
back on the
box up
past
there.
year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession.
Ooh, he is smoking
Not
people
only did
right
that not
now.
happen, we actually
You
had
hear
a
what
very
he's saying
strong
right here?
year. And that
Victory
was a
lap
combination
time, baby.
of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks, really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. It didn't really happen. We're still at 3.7%. So we've seen
looking for a high tick
strong
right now in
growth,
SPX.
still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating
with a
against
smooth
the fall
reversal
in
here.
prices,
Tesla coming
the
back
price
in to
level,
retest its
that
daily
you're-
high
the rate of
at
inflation that you're expecting,
236.90.
as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest,
Are any of you
again,
guys going
significant
to
progress toward
short
greater balance
4,700?
across
Let me
a
know
very
in the chat.
a broad
Are
range
you
of
gonna be looking
indicators.
to
You're
grab
seeing
some
that
puts or calls
so many
for,
of the indicators coming
Wednesday
back to normal, not all of
into
them.
Friday or anything
so I think
like that, let me
people
know.
look at that and they write down they basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know,
I don't think those are fucking
it's so hard to
printed.
know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out. given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election? Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully, so as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
They're looking to push us over, man.
So this last year has been remarkable for
they're looking to blast us right up
the sort of seesaw thing, back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress.
Next
I think
target
it's
above 4,700
it's really good to see the progress that we're making.
Is 4,750.
I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So it's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina. Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient?
For you if you want to take a look at that chart.
We'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, as we make decisions about policy changes going forward, we're going to look at all those things. and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%.
Look at that. Look at that SPX, dude.
If we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Hold on a second, here. Hold on a second.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, just a lot of things. It's you see job growth.
I'm closing some calls here, and I'm actually
still strong,
about to
but
buy
moving back down to more sustainable levels given population growth and labor force participation.
This is extra money. 465p
the things
for
that are not
tomorrow.
quite.
So I've got those on
Let
now.
me go on with that list. Claims are low. If you look at surveys of businesses,
puts for Wednesday still.
They're
but
sort
I've
of
got
the era
puts now
of
for tomorrow. I just added on
this
for
frantic
tomorrow here
labor
for a roll
shortage
down.
are behind us, and they're seeing
Next
the shortage
level,
of labor
if
is
you wanna
being
see where that
significantly
is.
alleviated. If you look at shortages of workers, whereas they
here.
thought job availability was the highest that it had ever been or close to it. That's now down to more normal levels by so many measures: participation, unemployment, so many
475.
measures, the unemployment, job
Any
openings,
is still long here.
quits,
I
all
am
of
no
those
longer
things.
long. I am
So
out right now. I've
wages
got just
are
a
still
full load
running
of fucking
a
puts
bit
here,
above
so
what would be
I don't know what you
consistent
guys
with
are
2%
doing, but
inflation
if
over
you
a
are
long
that
period of time. They've
bullish,
been gradually cooling off, but if wages are running around 4%,
here.
that's
You are
still
that
a
bullish.
bit above, I would say. And I guess there are just a couple of other. The unemployment rate is very, very low. And these are, but
there,
I
you
would just say
squeeze.
overall, the development of the labor
know
market
what
has
to
been
do
very
here.
positive. It's been a good time for workers to find jobs and get solid wage increases.
Trade your way, right? We trade up, come back down.
Hi, Jones, Financial
we
Times.
hit that 1 minute trigger, and you want to start trading
I'd
that.
say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. Yeah, when we hear from the general public, there's a lot of discord about economic conditions.
Wonder where
What do you
you're
think
at. Look at
explains
that
this
up there, dude.
disconnect?
Look
And
at
does it matter
that.
for policymakers?
Look at that right there. Look at that.
It may be
Trying to form
a common
a
theme
new
is
support
that
right here,
while inflation
trying to
is
form a
coming down, and
support.
that's very good news, the price
need
level's not
FOMO
coming down.
bulls to
Prices
buy
of some
tons of
goods and
480Cs,
services are
tons
coming
of 'em.
down, but overall,
Like 3 months out, 2
in
months
the
out.
aggregate, the price level's not good. So people are still living with high
Need bulls
prices.
to full port 480.
And, that's
Got a new wall
not
up
that
there.
is something that people don't like. And what will happen with that is wages are now real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that
Bulls try to
that
make
might help
470 the floor
improve the
right
mood
now.
of people. But we do see those public opinion surveys. The thing that we can do is to
This is a
do our
good fucking
jobs,
day, dude.
which
I'm
is
stoked.
to
This is a great day. I'm happy.
use our
happy
tools
guy.
to foster price stability, which
Try to-
has such
try to-
great
try to
benefits
turn
over
this
such long periods of
resistance
time, and
into
which is the
support
thing that
right
really
now.
enables us
So trying to squeeze this
work
up,
for
whoop,
and achieve
come back down and just
an
hold.
extended period of high employment, which is so
that's the
beneficial
floor right
for
now they're trying to make.
families and companies around the country.
Slam it up to 475. Come back down.
Hi, Victoria Guido with Politico.
Trade
I wanted to ask,
472. Look
you
for
know,
480.
on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Any kind of like scam roll over into the end of the day.
If the economy starts to looks like it's starting to fall into recession, if the jobless rate starts to rise.
Good, got my fill.
That's not something we're hoping to see. Obviously, we're hoping to see something very different,
folio
which
up
is
80% today.
continuation of what we have seen,
fucking run has been fucking phenomenal, dude.
the labor market coming into better balance without a significant
If you
increase in
want to trade
unemployment.
this,
Inflation coming down without a significant increase.
if you want to trade this from here to the upside, if you're believing that we can go higher today, take the money and get cheaper. Get like a cheaper call package, something like that. 100, 200, 300 rack of calls if you want. Throw some fucking lottos out there. Just don't base your whole entire portfolio on us going to 47.50 today, okay?
Certainly, the labor data
Something
would
like
be
to put the
important.
time on them or something
And,
next
you know,
week if you want.
if
Month out, 3 months out.
You can describe a
personally,
situation like that
flat.
where
I got some
if there
puts
were
for
the beginning
tomorrow.
of a
I
recession
had
or
some,
something
I had
like
some
that,
more
then
fucking
yes, that
puts
would
up here.
certainly weigh heavily in
And,
that
I got some dead 0 dates for today, but they cost me 0, and they're just a hedge.
Mike
So-
McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve
A fucking
and
great
starting
day,
to
dude.
raise
All-time
rates
highs,
to fight
man.
inflation.
All-time
and you said
fucking
earlier,
highs, baby.
Again, the full effects of our tightening cycle have not yet been felt. How will you
All-time
decide
highs, baby.
when to cut rates, and how will you ensure you're not behind the curve there?
Let's take a look.
So we're aware of the risk that we would
4818.
hang on too long.
4818.
We know that that's a risk, and we're very
4818 on
focused on
SPX.
not making that mistake. And
4818.62.
we do regard the two. You know, we've come back into a better balance
Let's
between
look at it right now. I'm
the
gonna
risk
show
of
it to you.
overdoing it and the risk of underdoing it. Not only
Hold
that,
on one second here.
we were able to focus hard
You wanna
on
see it?
on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of them, one of the two mandates. You're getting now back to the point where both mandates
They're
are
gonna make that
important, and
level.
they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. You know, we're obviously
is,
looking
right
hard
there.
at what's happening with demand. And what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good
There's all-time
reason
highs
to
down below
believe
if you want to see it.
that growth will come
4818.
in lower next year. And you see what the forecasts are. I think the median growth, median.
All right, maybe I'll grab some. Should I buy some calls here?
1.4% growth.
Hold on a
but,
second
you know,
here.
we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and you know, the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to
got a
articulate,
small
with
position
one
on
exception, really
471.
specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is, these are things that we haven't, you know, really worked out yet. We're sort of just at the beginning of that discussion.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, you know this, but allow me to say it again. We don't debate or discuss what the right, you know, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's, you know, it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out.
Holy
and
shit,
we've seen
printing.
real progress.
Holy shit,
it
dude.
has been sticky, and famously the service
went from like
sector
26
is
to
thought be
39 cents
stickier,
here.
But we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina. Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, how that kind of adds to your thinking, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, but nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, a little maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay, and do you see, how are you, when you think about, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is a really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment.
Mr. Takamonkey saying person of the year runner-up, Jay Powell. I agree, man. Whether it holds true or not, you're going to see that talk, aren't you, Mr. Takamonkey? Absolutely. Whether it's true or not.
It's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing.
Yeah, I see that too on ES, that swing high on Blisswood saying ES still has a little room left to break its prior swing high.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late.
If we get up here, right, I don't know that we do, but if we get up here
restriction on the
to the huge squeeze, I'll play slap that ask for you. But only if we go up there. I got some lottos for this trade right here. I got lottos for that happening. I don't know if it's gonna happen.
It takes a while
but if it does,
for policy to get into the economy.
This is just a lotto trade. It's very small.
So I can't give you a precise answer.
But if we get the huge squeeze up there, I don't know.
SEP And, you know, I
don't know if we get that, but
and things like that it would take.
We'll just let them die on the fucking vine if that happens.
Reasonable?
I wouldn't want to identify any one precise point.
First pullback, check the 1 minute trigger in a fair amount of time. Last time we checked it down here, tagged the 1 minute trigger. Came straight up, tagged it again, and made another run higher. So we'll watch this back check and see what happens here.
Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past
see if this holds on or not.
Talked about the more difficult.
If we do break the 1 minute trigger, you do know that we're going to see down below here. So be careful of this rollover here.
I'm curious.
You don't want to see any kind of this happen here and then price come back up and then we start to reject to the downside. So just keep your eyes on this whole structure.
Something different about the U.S. economy.
I think this. You know, we felt.
Bears probably getting all fired up here, looking for a failure of the 1 minute trigger.
The first factor is just the unwinding of.
Bears are looking for something just like this.
And the second thing would be our policy, which
we're looking for that right there, and they're looking for this right here.
Recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
They're looking to get underneath right here. Whoop, whoop, whoop.
If there was something different about the U.S. economy.
Yeah,
looking to come back up right here.
It may or may not be about the U.S. economy being different. I think
and then looking to blast you straight down here.
Is not the classic
and they're looking to do this to you.
Demand overload.
I don't know if they get it though. They got to get underneath.
Think about it. It was a combination of
you can't have these green bars right here. That's bullish.
Unusual supply side restrictions.
You need to have the bloodletting down here. You need a bloodletting down here. You need a liquidity break.
So this is just very unusual.
So that green bar is not bearish yet. You need red bars underneath.
A lot of, you had essentially a vertical supply curve because you ran into the limits of capacity at very low levels because there weren't workers and because.
Come on, bears, put your back into it.
Broken. So we had the view that
put your bears into it. Bears, you got gamma on your side, man. Put your back into it.
And something like that has happened. It happened so far. The question is.
Go Bears!
Once that part of it,
come on Bears!
The ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it gets down to demand, and it gets.
Bears need that sweet, sexy one red bar, man. But just push it down, one bar. Come on, Bears.
That the last mile is going to be different. I'm reluctant to,
We're in positive gamma, so that you'd expect dips to be bought on the hourly trigger in positive gamma. So hourly trigger, if you're looking for a rebuy, hourly trigger on dip buys if you're a bull.
Although we kind of assume that it will get.
You should expect all dips to be bought on hourly trigger. Half hour hourly trigger, either or, one of the two.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is
way down here. It'll come up though. You can do so. Hourly triggers right here.
I think we're down. We're close.
So even if we squeeze up here, let's say, right, and then we bounce around, and then as time passes, couple hours, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. If that gets bought, rip higher.
Or as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out. And at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve.
Apple traded 198. We talked about 200 on Apple this morning, right? The target was 200. They tried to sell 198. First round of sellers came in. Doesn't mean we won't slam 200, but they did arrive early. Some shorts did step in on Apple at 198, just a heads up.
With reserves close
TNX getting just destroyed today.
Those reserves, there isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected. We think.
NDX getting a little smacked down on 16,570 something.
Cuts, is that time to rethink, or are you still going to follow that thinking?
HYG, dude, in straight fucking beast mode today. Straight beast mode to the upside. Just hanging dong today.
Can you
Dixie bleeding out on the daily charts.
At such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal.
Apple with a little blood. Be careful here. Watch out for a liquidation break to the downside here.
To know what the reason is, to know whether it would be appropriate to do those two things at the same time. Thanks very much.
Apple coming into its 130 EMA on a 1-minute chart, looking for a bounce. All right, that's what we got there. All right, let me turn this off really quick. He's leaving right now. That wasn't priced in, right? We talked about this earlier in the broadcast. We had priced in a pause and a hawkish Fed. We did not get the hawkish Fed. This Janet Yellen this morning was giving that tip of the hat to that. A lot of guys on Twitter were doing the same thing. Timorous was doing the same thing, and then the press release detailed that as well. We went into the presser conference with Jerome Powell. It ended at 3:16, not 4 p.m. So quite early for a press conference. He seemed to be taking some kind of a victory lap in that presser. He wasn't dressed hawkish, and he did switch to from the hawkish Fed to the dovish Fed. So we got a dovish Fed, on at least my perspective. You can see the squeeze higher from here. Note that we broke through the 4,700 gamma bar. Doesn't mean we're going to hold it. You'd need to stay above it for us to begin to build a level there. Otherwise, there's a magnet down below to 465.0 and 460. Let's just be careful here now that everything is over, right? You're going to see IV crush. All that kind of stuff start to come into play here in just a few moments. I am fascinated by if they buy the dip into the bell for tomorrow to go up, or if they let it continue to roll down to catch the other side of the implied move for the week on the options chain. So be aware of that as well as the day progresses and into tomorrow. Trader Podcast, is that your meme? Should I play that? Let me check that out, brother. Hold on, Trader Podcast. I can't copy that for some reason. I'll post it for you. Let me see if I can get this. Let's see what we got, Trader Podcast out there. Oh, yeah, baby. Oh, yeah, Trader Podcast. I see that. Time Magazine Person of the Year runner up, baby. I see that, Trader Podcast. What should I play for your meme today, brother? Oh, I'll play this one. Let's play this one right here.
Welcome, new followers. My name is Trader Podcast. Those foul-mouthed Jerome Powell videos, I make them for fun. Sometimes when I'm not scratching my balls, I share charts, options, positioning, and financial data. So thanks for the follow. And hit that notification button so you can see my posts as soon as they pop up.
That's not
Welcome,
the one.
new followers.
What's the one Trader Podcast that you had in here? There was a great one they had with music. Is this it right here?
It's been a year since we've been doing these mock pre-FOMC press briefings. So let's get started, shall we? There won't be any rate hikes or cuts because my hands are tied. The rate of inflation is slowing down. Yeah, you are paying 3 times as much for food as you were 2 years ago, but you know you can still pay the tip on top of that. You dinks putting out videos about how great it is to not have any kids. This is why I must break the American middle class. You idiots are running up the Ponzi cryptos again. Good job. Yes, queens and kings. Make way for my plans of a centralized digital currency. You're just making things easier for me. I do have an announcement to make. I will be going on tour with my band soon. We are releasing our first song called JP's Got You by the Balls. Turn on the music. You guys will love it. Every call you take, every put you make, every bond you break, every spoof you fake, SEC is watching you every single day. Every word you say, every game you play, every night you stay, I'll be watching you. Oh, can't you see? You belong to me. Fuck your puts, fuck your calls. JP's got you by the balls. Every bid you take, every move you make, every bond you break, every spoof you fake, he'll be watching you.
There's one still up there.
Oh, his name is Jerome. He'll fuck your puts till you go home. I've only known it. Oh, how his poor heart aches every rate hike he makes.
Congratulations.
Every
Bulls.
call
Cycle,
you take, every put you make, every bond you break, every spoof you fake, SEC is watching you.
Talk about market the end
Oh,
of
can't you see?
Fucking awesome. Congratulations.
You belong to me.
Any of you out there that
Fuck
made
your
it,
puts, fuck your calls.
congratulations. Any of you bulls that were in before this
JP's
rate
got
cycle,
you by the
congratulations that you're still here. If you're a bear and you made it through this entire cycle, made some money, congratulations. All right, let's go through your chat and see what you guys are talking about here. Let's see what you guys are talking about. Now, number one, I want to say, well, let's go back to that. If you, I want to say something special here, because we had like the rise of retail. We've had cycles of rise of retail, like Yahoo message boards. There was some Usenet stuff before that. Had a rise of retail and Wall Street bets, all that kind of stuff. 2016-18 found a big rise in retailers. If you are a retailer though that joined the markets while you were stuck at home for COVID, and you are still in this market, whether you're flat, down, but still have money to spare, if you've made tons of money, you've changed your life, and you are still hanging on to today, because there's been a huge washout of these people. Millions. I made a post last night in the middle of the night about Wall Street bets. That a lot of the traffic there reminds me of when the sub had less than 150,000 followers. There's now, I think, 15 or 25 million followers, something insane like that. The washout of traders, retail traders that came into the market during COVID into today is astronomical. And if you are still here in this market in some way, shape, or form, I want to give you a big hats off to you. I don't care if you're a bull, bear, buyer, seller, whatever you are. If you've made it to this point, congratulations, okay? Very rare to see that happen. And my hats are off. My hat is off to you, period, okay? Hats off to you. And this looks like the end of a cycle. This really does. Even if we got another rate hike, this is the end of the cycle. Some of the notes that were inside that press release today have all participants saying that rates will be lower at the end of 2024. So if the expectation here and the market is saying the end of the rate cycle is coming in 2024, congratulations, you made it. Good job. Put a feather in your hat. Seriously. Hell yeah, you need it in your Spotify list. Congratulations, Bull, for trading. Hold on, I'm going to allow that one. We're going to allow that comment that was held by the auto mod. Darth Molly or someone saying I that my playlist on Spotify. Getting a little bit of a roll right now. What else we got going on? TP, is Elon going to go? Incredible. What do you guys got going on? Why is Bob Cut Dude's got suspicious automod? I don't know why that is. Hey, Bob Cut Dude, I don't know why they're holding your messages. I apologize. Let's see what you guys are saying in the chat here. I'm on YouTube trying to read the chat right now. You guys are hilarious. I'm reading some of what you guys are saying. Take like 10 seconds to look at Rivian. Yeah, we can look at Rivian if we have some time to look at Rivian if you want. So I want to give you guys that song, okay? So I'm gonna repost that song on my thing right now, okay? That song comes from a friend of us, a friend of ours called Trader Podcast. I'm gonna go to his page right now. You should follow him, okay? I'm gonna give you his page right now, and give me a second here. I'm going to write follow Trader Podcast. Make sure you're all following him, please. And he's got all this stuff. This is the guy that's doing it. He's not like, he puts this stuff on Wall Street Bets, and he gets like people love him. So follow Trader Podcast. I just posted that on Twitter for you. Kill it with fire. Oh, do we get Beartown now? Look at that, huh? Let's get rid of some of these support and resistance levels, and let's trade this just like we would, just using the tool here. And we're gonna look for these. Remember we said about the half hour and the hourly trigger down here. Let's just keep an eye on this stuff. You know the yellow line is the pivot, just as a heads up, right down there. Let's see what happens right here. See what we got going on here. I'm going to launch this. Please do me a solid here if you could help me out. I'd appreciate it. I want to talk about supporting the show here. You don't have to support us monetarily, but if you can do me a solid, please like these videos. Give them a thumbs up. If you're on YouTube, please make a comment, not in the chat, but down in the comments of the video down below. If you can. Anything. I don't care if it's positive, negative. You can say Captain Jim James sucks, whatever you want to say. It doesn't matter. It just helps the algorithms to push these videos. If you're on Twitch, if you could give me a like, I'd appreciate it. There is a donate button somewhere. Here, I'll find a fucking donate button. If you want to support the stream and what we do around here, it costs us a lot of money, a lot of time. You want to continue to see us do what we do. If you're making money, if you're not losing your ass in the market, if you're one of those people that are like, I only want to pay for results, whatever that you might be, there's a donate button that I'm going to post. I posted a link to get inside of our Discord. If you don't like money, though, if you're like poor trader or something like that, new trader, find me on Discord. What I'll do right now is, how about this? If you get on Discord and if you say, follow Captain Jim James, and you follow me while doing that, I will follow you back right now in person on social media. So I got my notifications up. If anybody wants to follow me, if you got no followers, I'll follow you. I'll put you on notification. Here we go. There we go. We got people following Trader Podcast too right now. Congrats to Trader Podcast. Thanks for helping us out with that on the show today. So a bunch of people following Trader Podcast out there. And I will follow you back, baby. I will follow you right back. So I've got my last tweet on Twitter has his handle. If you want to follow Trader Podcast, you go there and you follow him. And then if you follow him, number one, put him on alert, and then number two, scroll through his profile and you'll find all of his videos. He's been posting these videos for a period of time now, a long time now, and they're fucking phenomenal. You see, they get shared all over the internet. He's like semi-famous, man. So follow this guy, really cool guy. And I know him outside of the show. We get along really well. We love talking to each other. So follow this guy. As a matter of fact, I'm talking to him right now to see if we can get him to get inside the network. We have David AMS. We've got John L. We're trying to get Trader Podcast in there. A few other people trying to get these people to be there for you guys and be a part of our community. Tie them into what we're doing. Oh, I see you, you dirty dog. I see you, talking monkey out there. Gave you a heart. I see you out there, Steve Minshaw. What do we got here? Oh, wait a minute, I gotta follow Scott in here. Who's Scott? All right, I'm already following you. Good job, Scott. I'm already following you, brother. Trying to follow people
so
right
now.
now.
To the early market on close imbalance, currently sitting at 261 million to the buy side.
All right, so let's do some chatting here. So you've got bulls trying to build a support at 4,700. Okay, that's what they're trying to do. Hold on to 4,700. What's going to happen is you're waiting for call expansion. Lots of call buying at 4,800, possibly even up to 5,000. The preference would be 5,000. The more you expand those call walls to the upside, the more chance that we can actually trade that up there. Right now we had a call wall at 460, then we had a call wall at 470 with higher levels being developed into this morning. We reviewed that this morning with you on those higher call walls being developed. I did post a post on Twitter with the gamma levels, so you can take a look at those and that development that's taking place to the upside. Otherwise, if we don't get those call walls, the call wall expansion to the upside, we will trade back down to that 4650, that 4600. Coming up, on the 15th, we have some gamma on 4,600 that leaves the market, but it's not enough for any consequence. That 4,600 does not expire until end of year, not until end of year. And on the underlying of that 4,600, the single ticker issues, so it's single ticker issues supporting all of that, none of that stuff expires until the third week of January. So if you're looking for significant downside moves like, oh, we're going to blood back down to 4,000, any of that talk shouldn't come to fruition until our usual seasonal weakness in mid-February and mid-April. Hey, did you, hold on, Cowboy Up, did you reply, did you send a feet pic, brother? Hold on a second here. Did you send it to me? Oh, yeah, I didn't get any from you. No feet pics from you. Dude, I got Cowboy Up send DM podcast, or DMing podcast feet pics, brother. Let me take off my socks. All right, so let me take a look around here. I am going to leave the stream up at this point. I will leave it up till 4 p.m. It's 3:33 right now. But I'm going to get off stream. I got stuff to do. I have to get together with these developers. This developer is showing me some stuff, and I have to get to him. So I will see you tomorrow at 9:30 in the morning. Stream will stay up. Feel free to talk to each other from now until 4 p.m. If you want, I'm so stoked here. If you're looking for a dip to buy, right here, baby. This hourly and this half-hour trigger. If you're looking for consolidation so that half-hour and hour gets up there, that's possible as well. Bulls want to hold on to 4,700 if possible. And we're messing around up here, dude. On SPX down below here, we're diddling with it. Look at it. We got the roll right down here. And they're like trying to just build that 4,700 support, trying. They're trying. The bulls are trying. Dude, it's fucking phenomenal. Okay, so saying all of that, if you are a longtime follower, we're going to have to put together a private stream for Christmas, Hanukkah, Festivus, whatever it is you do, okay? I got to get some notes out to you right now that I need you to hear before you get off the stream. Number one, on Friday, I begin a vacation for Christmas and the holidays. I will continue to stream throughout the holidays. I will be here for you where other people stop streaming, stop making videos, take vacations. I promised that I would do that this Christmas and New Year's for you. So I will be here with you. Number two, we're going to have a holiday private stream. We're going to discuss the implications of all of this into next year. We've already done this in the past, but we're going to revisit it all for that front running into rate cuts. You need to know about that and how price matters. So when we're going to have that private stream, I think 2 days after Christmas. So the 26th or 27th, it'll be private. And it might be like in person. If you want to just do voice, you can. But if you want to be on camera, we have a small room full of people. I don't know how many they're going to allow me to have in there, maybe 30 or 100. So if you're interested in that, you've got no family, no friends during the holidays, we will get together. We'll have some bourbon or something if you drink tea, whatever you do. And we'll do an informal get-together, get to meet and know each other kind of event. So look forward to that as well. And then this Friday, we are launching the website, hopefully. If we get that launch going, look for something for me. If you're trying to sign up, there is going to be, for early adopters, discounts, okay? I want you to know that you're going to have discounts for early adopters into this launch. So keep your stuff open for that. Look towards Trade the Trigger, the handle at Trade the Trigger on Twitter. If you don't know that handle, you should see some information pushed out. There are caps on these discounts. So if you're looking for the banger discounts, you want to be like in the loop on that stuff as we launch. What else do I have for you here? Anything else? Yeah, we got some killer deals coming out. So if you're like, we got hard limits. So some people are going to get some banger deals on supporting what we're doing around here. So I'll talk to you guys soon. What else? We got anything else? Any questions on the stream? Any questions that aren't, can I look at this chart? Anything but, can I look at this chart? And I'll leave this up for you to 4 p.m. I'm poor. I need banger deals. You're going to have banger deals. Can I get you by the balls? Stacy, nobody follows you? Stacy, what's your handle? I'll follow you, Stacy. I am, are we lessening our exposure here more tomorrow? I'm a believer in trading the 1 and 5 minute triggers, buying dips on the hourly trigger. That's what I'll say to you. I'll trade it off of that to 6,000. Does that make sense? So you're buying the 1 and 5 minute trigger. You're buying any dips to the hourly trigger. If you follow those rules, you should be fine with stops underneath you. If you want to hedge here for some wake-up bloodbath, you should get hedged with a putback spread, but still be bullish here. I've been saying this all along. I'm reading some Twitter comments right now, and I'm like, I don't understand people. I'm like I just bang my head. That's okay. What else? Let's see what else we're reading here. Long to medium term holds. I am looking so I am out of the market on underlying. I am looking to buy the market again. Into today I was like, yeah, I want to buy March or April lows, but I am personally of the belief that we're going to get a pretty big back check leading into those rate cuts. So if you're expecting rate cuts into, let's say they start in October, September, they'll probably front run a pretty big move down before we get there. Now, price wherever we are will matter, but whatever that pullback is, I will be there to buy in a pretty big way the stock market. I love you, Chase, brother. I got you, man. I love you, brother. If you are there are people here that do a lot. You're not going to be paying. There's going to be people here that have been breaking their dicks for years. I'm going to take care of those people. I want you to know that too. Like an admin or a moderator that's been breaking dicks. If you've been behind the scenes with me, you guys behind the scenes that we're on the phone every day, I got you covered. So any of those people, don't worry about it. No, I got you covered, guys. Oh, wait a minute. Stacy F., where are you at? Stacy, is that your Stacy, is that you? Hold on, let me check this out, Stacy. Hold on. Stacy's putting her thing out there. Hold on, Stacy. Hold on, Stacy.
Early market on close imbalance.
I'll push you out there, Stacy. You want some followers?
Million to the buy side.
Hold on. Supergal wants some followers. I just did a copy and paste, and I'm seeing hearts in this copy paste job here. Do I have you there? Oh, there we go. Follow Supergal. I gotcha. Posted. Done. What else do we have here? Done, Stacy. I just did it. Follow Supergal. Her handle is at Utah. What was it? UOF. Oh, U of F, a Wildcats girl. U of F, a Wildcats girl. Dude, I like that handle, Supergal, by the way. The 1 minute, all this stuff will be available to you on Friday. On Friday, you'll have access to everything on Friday. And we have more shit coming, too. I got some cool shit coming to you guys. So I got some really cool stuff that will be rolled out over time. Look at these bulls, man. They're trying to make a new level, dude. They're closing the door to 4,700 right now. And we've got a supply bar to the upside up there. They're closing the door, man. They're locking the key. Yeah, cowboy up. I'm flat, man. I got some puts, and that's it, dude. They can do whatever they need to do here. If they want to consolidate all this, I'm fine with it, but I'm done, dude. Done. Done for the day, done for the week. It's been great. How do you learn more about the hourly trigger? Come back on the stream on Friday. Come back on the stream. You can follow me on Twitter. You can follow at Trade the Trigger on Twitter as well, and you'll find out details. You can join us in the Discord if you want to, and you'll find out details. Let me get the Discord link. You can get inside the Discord, and you'll be notified. If you're not on Twitter, I will get you that right now. Okay. Oh, wait a minute. Nope, that's wrong. 1 second. Post all this. There's a Discord invite for anybody that wants to get in the Discord. You want to be kept in the loop, find Captain Jim James. Just Google search me. You'll find me. There you go. Okay, I'll see you guys later. I gotta go. Look at that. Look at that support up there, dude. Ooh. Hold on 1 second here. Hold on a second here. All right, that's all I got for you guys. I think that's it. I made a post there. I will see you guys tomorrow, baby, 9:30 in the morning. Have a great night. Dude, I'm going to a Sunday bar tonight, too. My daughter's birthday is tonight. Super fucking stoked. She just turned 16 years old. 16 years old, man. Sweet 16. I can't wait. It's going to be awesome.
Close imbalance. Still
I will see you guys soon, baby.
To the buy side. So looking now to the market on close imbalance, 350 million to the sell side. So again, market on close imbalance for the NYSE, 350 million to sell.
But it explains a 12 VIX because we have things moving in different directions. You have low correlation for now. And to me, again, I keep saying this, it's one of those things that reminds me of like 2017. You finished the year on a massive flourish. It was a melt-up market. Early 2018 is when you had that weird volatility storm out of nowhere because people got just completely kind of wedged into this low vol melt-up mode.
Liz, do you agree with Gundlach that he doesn't think that money's going to pour out of money markets into stocks? Where that's one of the bull cases here for the next major leg to, this market. By the way, S&P just hit 4,700 again. Just to let y'all know again, Dow Jones Industrial Average had a new all-time high, and could very well close there for the first time ever. Either anything above 36,799 and change is going to get us to that mark. But what do you make, Liz, of that idea that money is now gotten the go-ahead, so to speak, to come out of cash and into stocks? It may go into bonds, too. But a good enough portion of it is going to come into stocks, and that's going to make a difference.
Well, think about the reason it went into money markets in the first place. It went in because you could get 5%, more than 5% in dividends or in a yield with little to no risk. So you'd have to convince people to come out of a 5% yield, and that may happen as the 2-year comes down because it won't be as attractive anymore. You have to convince them to come out of a 5% yield with little to no risk into parts of the market. I think the expectation on some is parts of the market that are already overvalued. I don't think that's going to happen. And I think you see sort of a slow flood from money markets as rates come down. But I think he's right. It doesn't all go into tech. It doesn't all try to jump on a bandwagon. It probably goes into the more attractively valued areas of the market. But we talked about this the last time I was here, too. That's the tipping point. If money comes out of money markets and people have enough risk appetite to deploy it into cyclicals, not just utilities, not just staples, cyclical sectors and credit and high yield, then that tips us into maybe we breach the all-time high. You've got a rally that looks a lot more durable.
Josh, the Russell, better than 3%. It's 3 1/3% right now, approaching 2,000 on the Russell 2000.
I just think you have a smorgasbord of laggards that are now like almost putting in overtime to try and catch up, which is exactly what the thesis on the desk has been really since before Thanksgiving, the way that this year would come to an end. It's all playing out. Look internationally. Look at how European stocks look like they want to finish this year. Specifically, European financials, which have no business ever going up, rallying like there's no tomorrow. Then look here stateside. You got ARC up 3% today. You got biotech up 3% today. The businesses underlying those stocks are not rate sensitive. The stocks are rate sensitive, and they are moving. Metals and mining up 3% on the day today. I mentioned all the dividend payers. These have been lagging sectors all year, and in some cases, sectors where there's been a lot of pain. Utilities have been absolutely awful, but they pay a yield. Yields are coming down in risk-free. Therefore, you are going to see rotation into those high dividend payers or the dividend growth names. And I think it has legs into January. I don't think we're done.
Mike, we're on 3-handle watch for the 10-year. We're at 401.
Yeah.
And that's going to be a considerable story moving forward.
Yep. I honestly, a lot of folks, for good reason, thought it'd be sticky in the 410 to 390 area. We'll see if that does hold. It is interesting. As Liz said, you would expect maybe some re-steepening if, in fact, this is going to be the Fed is done and we can kind of re-accelerate a little bit in the economy and inflation expectations, maybe a bottom. I mean, you kind of have to start thinking in reverse of how it goes. But for as long as it lasts, it just takes the pressure off. The biggest impact, regional banks. They're flying because they're basically having their balance sheets refreshed by every move lower in the long-term yield. So everything is, it's hard to really find fault with a lot of it, except for the pace of it and the idea that nothing just started today. Today was just an extension of a lot of the things that got underway a couple months ago.
Yeah, better than 500 points now, highs of the day for the Dow. Josh Brown, thank you so much. Same to you, Liz Young. Mike Santoli, as always, he's going to stick around, of course. That bell marks a new record high for the Dow Jones Industrial Average, going to close above 37,000 for the first time ever. I'll see you tomorrow into OT with Morgan and John.
Closing at session highs, a record close for the Dow Industrials, hitting 37,000 for the first time ever after a Fed policy pivot. New 52-week highs for the S&P and NASDAQ, too. The S&P finishing right above 4,700. That is the scorecard on Wall Street, but the action is just getting started. Welcome to Closing Bell Overtime. I'm Morgan Brennan with John Fort.
And coming up this hour, we've got reaction to the Fed and the market's big rally. We're going to talk to David Zerbos from Jefferies and Krishna Guha from Evercore for their first takes on the Fed's path and the market's path forward.
Plus, a rare cannot-miss interview with investor Samantha McLemore, who worked for 2 decades with Bill Miller before starting her own shop. We'll get her top value picks to buy as stocks do scale to these new heights. Let's get straight to the Fed decision and the big push higher for stocks during Chair Powell's news conference, though, sending the Dow to a record. Joining us now is Jefferies' chief market strategist, David Zerbos, and CNBC senior economics reporter Steve Leisman, who is in the room with Powell. So, Steve, we're going to start with you because I heard you talking about it in programming on the last hour. The fact that this does seem like Powell and the Fed moving towards a policy pivot.
Yeah, pivot, a pirouette. I don't know exact word is, Morgan, but it's definitely a change. I thought he might have held the line a little bit for another month, perhaps. But I think perhaps two things happened. That the data made it untenable for him to stay quite so hawkish as he was, for example, just a couple weeks ago in an interview that he did. I also think he was losing his committee. I think the committee was moving on and acknowledging this notion that if it didn't start to forecast rates coming down with inflation coming down, that he was going to lose votes and have some dissent on the committee that was going to, I think, ultimately hurt policy. I do want to, I don't know what to say, throw a little cold water on this, if I could for a second, Morgan. If you do the math, the Fed is not projecting that it's going to get any easier next year, okay? What the Fed is going to do is it sees itself bringing down interest rates exactly in line with the decline in inflation. If you do the simple math of the expected funds rate this year minus the core PCE next year, this year, you come up with a 2.2% real rate. Guess what the real rate that you would project from the new SEP is? It's 2.2% next year. Now, you could be happy because there's scope for the Fed to come down more and become less restrictive, but at the moment, the only declines built in there are the Fed moving down in concert with the inflation numbers. Yes, they've taken off the table the notion that there could be additional hikes. I mean, they're at least notionally off the table. He didn't completely back off that. But in general, what's happening here is the Fed is coming down along with inflation. It does not see itself necessarily, on average, getting any easier next year.
Okay. Love the context and the nuance there. David, want to get your thoughts on this, what the dot plot signals to you, especially as we did see not just a rally in stocks, but a rally in treasuries as well, with yields dropping pretty dramatically, lowest for the 10-year treasury yield since August.
Yeah, and a rally in credit as well. Credit did great. I think that, look, from when I first saw the dot plot and I saw that the PCE core had only come down 0.2, but the Fed funds rate came down 50 basis points for the end of 2024, I was a little surprised. But then listening to Jay, I think I understood where his head was and maybe where others on the committee are. They're really watching inflation expectations, and inflation expectations dropped dramatically in the last few months. We had a break-even 10-year at 2.5% that's now 2.15%, fallen 35 basis points. So I think they're looking closely at inflation expectations, and that really added and probably got us that extra 25 basis points of projected rate cut in 2024, which was the fuel for the market. I think that's where the market really wanted to go. That's where the market wanted to see the Fed basically going fully into 3 rate cuts for next year. And that just set us off in bonds, credit, and stocks. The Goldilocks rally. But I think it's mattered there.
Okay. Okay, Steve Leisman, let's see if I can warm up the cold water that you just threw on this, because it seems like, in a way, you know, Chair Powell was saying, it's working, right? Like, so many people were saying, oh, the Fed doesn't know what it's doing. It's way behind the 8 ball on this. It didn't hike soon enough. It's hiking too fast, blah, 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 blah. And now it seems like the Fed, that was so hesitant to say we're getting inflation under control, it looks like we might actually achieve a soft landing, et cetera, et cetera. It sounds like maybe not dovish, but at least open to multiple types of birds, yes?
Yeah, well, let me just be clear, John. The amount of cold water I'm throwing matters only to the extent that the fire is burning hot, and I don't think it's going to have that much of an effect. And I'll add to what you said. I agree completely with what you said. That the other thing that's sort of taken off the table here is this idea that we're about to screw up massively and keep things too tight and create a recession before it's too late. I think that is something that potential risk is eased a little bit today. He did talk a lot about being aware of the risk of doing too much. He's talked about that before, but I think he underscored that. I also think that today was, a day when the Fed pivoted, but didn't do so with any, there were no balloons, there were no party hats, there were no kazoos or anything like that. It just said, you know what? We're taking that other one off the table. We are in neutral now with a forecast to cut. And those cuts are still speculative in the sense that the inflation data has to behave and come down. I think he got to a point where all of it added up. If you make a list and say, here's all the reasons I should cut and here's all the reasons I should hike, the hike reasons got to be fewer and fewer along the line and became a weaker and weaker argument.
Okay, now I do want to mention Adobe earnings are out. The initial move is down about 7%. Or more at the moment. We are going through those numbers and we'll bring them to you as soon as we can. David Zervos, is there a risk here after this move higher, this high on the Dow, S&P above 4,700, that there aren't enough people bearish on the other side of this trade anymore and things could be getting out of balance heading into 2024?
I do think people came into this year underweight, John. They were underweight credit risk. They were underweight equity risk. They've been chasing it all year. Look, Jay said this actually in the press conference when he asked, why did everybody get it wrong? And he talked a lot about the supply side. He talked a lot about vertical supply curves and the fact that the inflation shock was a supply-driven shock and the unwind of it was a positive supply shock. And that's been our view all along. And I really think that storyline and the fact that it could continue is something the market doesn't have priced at all. People came in wrong-footed to this year. There's a lot of people still talking about recessions, and they don't have a lot of credit risk. They don't have a lot of equity market risk. You're absolutely right, I think, John. I think there's a real reason why you could have some legs in the risk asset trade on all sides, on the credit side and on the equity side, going into the end of the year and even into the beginning of next year. And I really think Jay's story is a pretty good story for risk assets all around. It's a soft landing. It's a calibrated cut, as Steve was saying, really to calibrate real rates so they're not getting more restrictive. And it's a story that's not the one that a lot of others who were forecasting rate cuts called for. It's not a recession rate cut story. It's actually a kind of a positive, just get things back to neutral or keep things in check kind of rate cut story. And that should be pretty good for the equity market, and I think great for the credit markets too, because yields will be coming down in that environment.
So is that where you would be investing right now, in the credit market and in equities? How would you be positioning specifically?
Morgan, we've been advocating the junk bond trade all year. That's been, I've been on your show, talked about that a lot, been a lot of others. That's been a great trade, up double digits this year with a much better Sharpe ratio than equities. Look, I'm tempted after this meeting and after watching Jay to be a lot more amenable to the equity side of the equation going into next year. I haven't taken the full plunge. I like where I was in junk credit, and I think we've had a great run with it. But, a lot of things are adding up that Jay's view and the committee's view, really, of a relatively benign growth story, 1.4, 1.5% GDP growth, inflation heading back down to, the low twos, and a Fed that's slowly lowering rates. That's kind of a pretty positive story all around for all the risk asset space. And as John was pointing out, I think in his question, there's just a lot of people that don't have it. I mean, we just came into this year with people overweight duration risk and overweight a kind of negativity that I've had to overcome in a lot of client meetings. And I don't think they've gotten that back. So I'm much more open to being even a little riskier than we were throughout this year in junk bonds, and maybe going even a little more into the nether reaches of the capital structure of the U.S. economy, which involves equities.
Yeah, Steve, we had CPI yesterday. Maybe you could call it a little bit warmer than expected, but largely in line. PPI today came in flat month over month. Core PPI was also unchanged. You take all of that, you take some of these other inflation expectations that we've gotten in recent reports. How does it set us up for PCE, and how much is that going to matter for the Fed as we do head into a 2024 where that so-called last mile of inflation is going to be, at least if history has anything to show us, the trickiest?
Yeah, all good questions, Morgan. I mentioned it at 8:30 when the number came out. I mentioned it again at noon, and then I was flattered that Powell mentioned it again in his press conference. The PPI number does flatter the potential for the PCE number next week, and you do see some of those estimates coming down, or those with lower estimates were affirming it. You know, I was listening to David, and nobody does better, I think, at connecting markets with Fed policy than he does. And I'm just, and by the way, I do want to point out Jeff Gundlach in the last hour, he had the Fed cutting more because he believes there's a recession coming. I think that was important to point out. That's the other side of the story from what David's talking about. But I wonder if there's a third possibility here, which is that the Fed just cuts more because on a real basis, it doesn't have to be that restrictive. That there's no particular reason to maintain that 2.2% real rate or a 4.6% rate if inflation comes down and does better next year the way it's done better this year. So there were 5 members who were calling for 100 basis points or cuts or more. I called them the dissenting dots out there. I think they're a little bit more dovish out there, and we'll see if their call ends up being justified or backed up or supported by the data.
Big day for the markets. The Dow up 500 plus. Steve Leisman, David Zervos, thank you both. I mentioned Adobe earnings are out. That stock is down more than 7% right now in overtime. Pippa Stevens has the numbers. Pippa.
That's right, John. The stock is down on weak guidance, but starting here with Adobe's Q4 results, the company did beat on the top and bottom line, earning $4.27 per share adjusted. That was 13 cents ahead of estimates. Revenue coming in at $5.05 billion. That was slightly ahead of expectations. But once again, it is that light guidance. So for full year 2024, the company sees revenue between 21.3 and 21.5 billion, while Wall Street was looking for 21.73 billion. The conference call does kick off at 5 p.m. and right now shares are down about 7%. Back to you.
All right, Pippa Stevens, thank you. Morgan, we said yesterday on Overtime, watch out for a conservative guide on Adobe, but there's more to it, I think, than just conservatism here, because if you look through the numbers, the digital media business for Q4 actually came in slightly above the guide and possibly above where some were expecting at $3.72 billion. It was the digital experience line of business that came in even light, really, of guidance at $1.12 billion to my eye. And digital experience is that part of the business that's taking data within a business, and the business itself uses that to get smarter about its operations and about dealing with customers. That's really a very enterprisey piece of what Adobe does with data. Also in the Q1 guide, you've got the overall revenue, yes, is a little bit light, but the digital media expectation was for $3.84 billion. The guide is to let's see, I think right about that number, maybe a little higher. And the digital experience business, again, expectation was for $1.3 billion. They're guiding to just under 1.3 on digital experience. So it seems to be that enterprise data, digital experience piece of the business where demand is lighter, which is some of what we saw from Oracle yesterday. We're wondering which side was going to win out. At least on the operational numbers and on the guide, it seems like that weakening demand in enterprise is affecting Adobe's numbers.
When we start talking about some of the Gen AI tools that they've been rolling out this year, things like Firefly, where does that fit into the segment breakdown?
That's in the part that's strong. You're going to see that in digital media, right? That's the efficiency piece of the story that we were talking about, where some companies have been winning. But we'll have to see what the color is on the call as well. It seems like at least the losses in the shares after hours are moderating a bit. It's now down a little bit less than 7%. Let's bring in senior markets commentator Mike Santoli now with a broader look at the inflation picture. Mike.
Yeah, John, the market more emphatically treating inflation as last year's problem, yesterday's problem. David Zervos talked about inflation expectations. Here's what market implied 10-year inflation expectations look like. pretty much almost normalized back down toward the 2% level, which we had seen largely pre-COVID. So it seems like there's really nothing to be concerned about here. Don't write this in ink in terms of what inflation is going to be over the next 10 years. It's not necessarily the most solid forecast, but it shows you that right now investors are not geared up for more inflation. They're not going to behave as if it's coming. That's good news for the Fed. It endorses their new pivot, if that's what we're going to call today's action. Now, what do stocks do after the Fed pauses? At this point, looks like the Fed's pause from July is the end of that tightening cycle, and that would be this mark right here, vertical line. So this is the current path of the market. That was before today's rally, so call it right up just a little bit higher from there. And you see that if we don't get a recession over the next, let's say, 6 to 12 months, this has been the average path of the S&P subsequent to that. And, of course, the lower line was if there were a recession resulting after the end of the tightening cycle. Of course, the Fed will have cut before that happens, too, usually. And you see why it matters so much as to whether we get the so-called soft landing or hard landing. Now, there's variation around each of these lines. For example, 2007, the market did really quite well in the year, or almost a year after the Fed paused, but then, of course, it fell apart in the financial crisis. So this is the crux of the debate from here on out. Of course, market's not feeling very comfortable. The economy's pretty sturdy, and the Fed now has backed away.
Mike, where do you think traders are seeing the greater danger now? Is it in a recession or in a consumer who's perhaps more resilient even than we expect and continues to spend and perhaps drive some inflationary pressure that the Fed isn't prepared for?
I think it probably still leans toward incremental weakness in the economy from here. Now, obviously, remember last January, we actually had this huge run of really hot economic numbers. The consumers spent really heavily. We could get surprised by something like that again, I suppose, given what's happened to gasoline prices. Wages have still been growing around 4%. But I still think there's this residual sense out there that the clock is ticking toward consumer fatigue and an economic recession. Even though the evidence isn't showing it right now, we still got the inverted yield curve. You still have those lagged effects. You still have higher rates. You still have all these things that people are geared in that direction. So I guess if I had to choose, I'd say people are still a little more apprehensive about the idea that the economy runs out of gas than that it reaccelerates.
All right, Mike, thanks. And Morgan, a quick correction here. The digital media number on the guide for Adobe in Q1 was not in line. It was also a little bit under. The range is under that 3.84 that the street was looking for.
Okay, we're going to dig into these numbers a little bit more later in the show. In the meantime, ahead of this print, the stock was up something like 85% since the start of the year. Well, up next with the Dow at record highs. And oh, by the way, the Russell 2000 up 3.5% today. Where should you be looking to buy in this market? We're going to ask Samantha McLemore, the founder of Patient Capital Management and a longtime colleague of Bill Miller. She'll reveal her top value plays for 2024, including a big bank and a big three automaker. You don't want to miss this. Overtime's back in 2.